what we can do is, okay, here's your daily chart. Um, Yesterday we had a higher bar, and if you look at this is Friday, Thursday, Wednesday, Tuesday. I mean, this entire week, okay, it's been very choppy. Here's your 5 days. So all this is all we did. Now, if you look at the price compared to this, you can tell the difference, right? This is more directional move to the upside. This is prices just consolidating, right? It was down, went back up. And why is that? Is because S&P was up 6 weeks in a row. So it was due for some sort of a breather. So it could have, if this would have happened after 6 weeks, it would have just happened after 7 weeks. But the point is like, how many more weeks of higher highs are you gonna see before you take any sort of some sort of breather? And that could have happened after 5 weeks. But the point is like nobody knows that that would have happened after 6 weeks, you know. But this was the sell-off, a little bit of a shakedown that we had this week. Then the next day was the inside day right there, which I don't. Let me just tell you one thing. If I tell you that S&P or Qs are the inside bar daily, okay, don't expect me to throw any trade on the board, okay? So I don't trade these bars. I trade this to the upside or I'll trade this to the downside. I ignore this one. And these are the ones that I watch very closely. So the only four bars that you have, you ignore this one. This is the worst bar to trade on any stock on if the market, meaning the S&P or the Qs, will go into an inside day. Nothing's going to move. You might have Nvidia can go up 3, 4 points, but your rest of the Mag 7 is not going to move. It's just if you happen to be in those ODT options and any kind of it just these are not like even like if you have SPY calls, they're not gonna pay you anything. Market is the price is not breaking out or it is breaking down. You're just sitting right in the middle. So if you are a, took a trade based on going up, and if you have a price right in front of you that is not breaking out, well, you're just wasting your time. And that premium, the time decay is coming at you. So just you ignore them. Okay. GAN had the same thing on there. I mean, I've that thing is on the education on the channel. It says right there, you ignore those bars. Just look for trades that you could possibly uh, look, do for the next couple, like you can just find trades. What if the market takes a pause, like what you could find, but at the same time is very hard. It's not going to work. I know that. These are just choppy, choppy days. So here's a funny thing that, well, not funny thing, like basically what I'm seeing here is S&P, sorry, the SPY swing is down. This is up. As a matter of fact, yesterday NDX cash had made an all-time high. And small cap, 4.3%. That swing is down as well. This was down 2%. There's nothing here. And look at this. Dow Jones is puking 5 straight days in a row. And when does that ever happen here? Let's find out here. Here. Here's a year low, 371. That's the high, 433. Here's your 5 days down. The longest drawdown Dow had was 6 days. Here. That's five. There's blue arrow right there. 5 consecutive lower closes. This is 6 right there. Now we're at 5. And does it happen anywhere else? No. So when you have something like this is very rare, right? We didn't had any macro data or uh, hit the wires that earnings are coming up good, unless their one day was Boeing news, the second day is about McDonald's news. These are like Dow 30 stocks, right? But at the same time, financials and all the like JP Morgan, like all the other ones that reported so far, there's plenty more they're going to report next week as well. Like, and you have the entire index is down 5 straight days in a row. That's pretty rare. So I was thinking about buying 420 calls yesterday. And I was like, okay, if it's down for 5, the worst can happen on Monday that it can make another low. It will be 6 days down. I was like, okay, well, doesn't look like the world is coming to an end. I was like, what's going on here? It's gonna be due for a bounce. But I only got XOM. The price was right there at 420.47. I had a fib that that was right there. I didn't buy it. I was like, just I don't wanna. Well, then the news just broke out over the weekend about the war. Who knows how future would open? And now the news is like that thing, the show is over. So we don't have that so whatever they did, I think the I don't know what is that. It's like a cat and mouse game, you know? They're fighting rockets. Oh, there's no casualties, nothing happens. Couple weeks later, they're flying up the planes. They're trying to target some of these military bases and all that. And then Iran says like there's hardly any casualties or whatever. I mean that everything is pre-planned ahead of time. US knows US knows ahead of time that they're going to attack. Like, I mean, what is that? you know? Like you just like literally pre-announce everything. Like, okay, yeah, we're coming, stay well prepared, take all your stuff out from there because we just want to come in and throw a couple bombs just at those empty buildings, and you just move all your equipments and everything out ahead of time. I mean, really? What is that? What does that even mean? You know, you just given like a tenant notice. Yeah, pick up everything in the next 2 weeks because I'm coming to take your house. Okay, I have enough time. Now all of a sudden you're gonna come and bust somebody's door. What are you gonna do for everything which you have in the house? You know, it's like it's. I was watching the news and just most of them are fake, anyways. They're like keep saying about, oh, they're not going to target any of their energy, you know, yeah, nuclear reactor plants and all things like this. Like the just trying to calm everybody down, like not to create a panic, right? Because elections are coming in the next 10 days, and I don't know what it's gonna do to the oil, you know. Iran is a huge oil exporter, and and I don't know. I mean, it's so hard to predict. I mean, this 2 weeks is gonna be wild. Okay. I mean, I've I'm having a great year. Okay. I mean, I can just cash out everything and just call the year, to be honest. I really don't have to sit and trade. I can just take a time off, you know? I'm not gonna do, I mean, I'll be trading. But the point is like, I'm not dying to trade these sessions, which nobody knows which way the price is going to swing, you know, especially on the elections and stuff. I'll do the levels on the ES on the pre-election night, and I'm gonna have everything. I'll give you everything. If you wanted to trade futures, you can. Mini futures. No, standard ones are kind of a bit pricey. But you could make definitely. I mean, again, if I don't know what are you willing to risk or what you wanted to do, but futures are pretty well defined, just straight deltas that you're buying per contract. You have no time decay, you have no vega, you have no gamma, and you have no theta. All you have is just straight delta. So you're just going to play one directional move. So if you are planning to do that, I mean, because election results, they're not going to be finalized on the same election day anyways. You know that and I know that. Okay. Because neither of those sides are going to accept a defeat right away, first of all. I'm not trying to get myself into politics here or whatever, but I'm just thinking the outcomes, you know, the if Trump loses, he's never gonna accept his loss. He didn't even accept that he lost with Biden, right? Because he has no choice. But at the same time, the results are not going to be finalized until Tuesday, the election night. So it's going to be a lot of news. It's going to be depends on especially on the swing state because look, I don't know where you live or what, like there are certain states that they don't even go and campaign there, right? Because their main focus is what? Is only on swing states, both of them. So where they put the most money, right? Putting the most money right now, Pennsylvania. They're undecided voters over there, right? All the ads, nonstop commercials, billboard signs, you name it, right? So everything is there. So they don't come here to Illinois and do their campaign because Illinois is a democratic state. It's always been this way. They know like Chicago town is gonna be all there to vote Democrats. I mean, you cast your vote here being as a Republican, okay, fine, but the state is gonna go to Democrat anyways. You know, so I don't know the outcome or how the market will respond. But the last time when we had elections, market took a massive plunge to the downside, and that was on futures. And then when the session opened, market made a crazy rebound, right? So that happened with Trump and Biden. Okay. Well, I don't know which way first the market will swing, but if we're
That was Trump with Clinton.
the Trump with Clinton or
Yeah, that was
no,
Trump with Clinton, I thought, no?
no, Trump, no,
That was not 2016, that was 2020.
no, Trump ran against Hillary first and then Biden.
Yeah.
First term, he ran with Hillary. And then second term, he ran with Biden. And he lost, and Biden become now is Trump and, Kamala.
Yeah, I thought
So,
that big massive futures down was because everybody thought Trump had won and sold the market, but then they realized, well, Trump is good for the market.
yeah,
So they rebounded like
that's
crazy in the
everybody
market.
thinks that's where that Trump is really, really, he's going to boost the market and which he will, and I mean, again, politics is just a dirty game. It doesn't matter which part of the world you're in. It's the same way. Okay, it doesn't. You name a country in the world. Okay, it's the same politics everywhere. So it doesn't. So it has never changed, and it never will. They just keep picking on each other. Like one guy wants to divide this country and one is all about being united. That's all it is. That's all you hear. You know, close the border, tariff the hell out of these countries, and United States is number one. This and that. Okay, that's kick all the illegals out of the country. That's his approach. Second one, we need to be united. This and that, healthcare and all. That's all it is. I mean, look, we had 4 years of Trump. And we just had 4 years of Biden and Kamala. So it's not like that world or people are here, including us, haven't seen what has happened in the last 8 years. But the point now is like things are not bad. That's what everybody makes it sound like it is so damn bad. You know, market is up. I understand that not a regular people not invest in the market, but if you even working for a company and if you have your retirement account, don't you think it makes you look makes you happy looking at your quarterly statement that how much is your mutual fund has been up went up over the last 4 years? I mean, data is coming really good. Economy is strong. So what do you want? I mean, I just want to ask some people like, what else do you want? All-time high market and you have a great economy. What else do you want? So you build up, meaning that you build a house and then you just light up a fire because now you just want to burn them. It's the same thing. Like, okay, so you go up and then you think, no, now we got to crash. Well, market has cycles, and I get that, you know, but that doesn't mean that market is gonna go up high and then just gonna crash 50% to the downside. That's what everybody is talking about. It doesn't matter. S&P at 5,800, it can go to 6,000, it can go to 65. It's always is going to be expensive. It's just the way it is. S&P was expensive when it was 5,000. That was not that time market was not expensive. Of course, if every time when the price is gonna go and make a new highs, it's always gonna get expensive. So if it's expensive, doesn't mean that things just gonna plunge 30% because you wanted to get in because market just cares about what you think. I wish that's the case. Well, imagine where it would be right now. I mean, I would be retired long time ago. So the daily swings are it's a little bit of a setback after 6 weeks. Which I noticed and which I saw. Like IWM here is like yesterday was an outside bar. This was an outside bar. That is kind of gives a pretty good sign of form in the bottom on on the outside bar. It has a pretty good potential. It could um, make a move back to 426. So we'll watch and see what happens. Um, but the point here is like you making a higher bar, you look at the high, look how much do you just literally everything is gone by the end of the day on cues. And then like you see, like they're not matching. I mean, you can make a case here of um oh you're putting some comments. I didn't even read yet. I'm on the side here. Real estate mar I'll look it up. Yeah. So this one has the decline here of these three. How are we gonna match this as a wave count? I want you to think this way. You see the direction of this swing compared to this versus this. That's the tough part for me when it comes to Elliott wave. Okay, to match a wave count when you see this, it's not gonna work, and it's never gonna match. Now here's the thing though. S&P, which has outperformed Qs for some time, right? When which we've been tracking it. Now, for this week, if looking at the price, now if we go to a weekly bar, look what happened here. Lower bar, that's a lower bar for diamonds, right? That's a lower bar for SPY. That's an outside bar for Qs. But the outside bar that this one has not passed above 503.52. That's the all-time high of Qs. So NDX cash yesterday had made a 52 weeks high. Qs did it. Okay. So remember that one. So remember this. Okay. So Qs didn't. We still got 3.5 more points to the upside for this for Qs to make a new high. But then if we go to XLK, XLK didn't make a new high either. A little messy right there. XLK all-time high is 238. Okay, so NDX cash did. The Qs and XLK has not made a new high yet. What I think, which I don't have any signs for it, um, the two, I mean, I don't know, it's just tough call to make, because I don't, I like to trade what I see, not what I think, right? But it's very difficult to position yourself just based on and assume like this is all it is, and we just buy puts and cross our fingers and hope we get lucky. I don't have that kind of a trading approach, you know? I mean, it's just there's just prices consolidating right there. And in which I was kind of like prepared, like it's gonna be a little bit of a choppy week. The reason why it being is because we have Mag 7 earnings are coming out, and market normally don't sell off sort of right at the earnings, but the earnings will depends which company will surprise us. I mean, so far we only had two. We had Netflix that popped hard, and we had Tesla. So two of them are out of the way, and they both did good. The way the price has, responded to the upside. But the Amazon, Google, Meta, Apple, they're the big players are coming. So we don't know how the earnings are going to be, what they have to say, which company is going to announce a new buyback, what they have to say about the AI, how much money they have spent. We will see when the number is going to come out, but we cannot make a wild guess. And I don't expect that each and every one of them is going to pass the test with flying colors either. You know, one, two will miss. you know, that's where the shakeout can happen. The most important one is always Microsoft, right? Microsoft can, if it goes up, but the Microsoft is such a kind of like a sneaky stock, is like if it drops, there's so many buyers are waiting for the stock to drop, and they just picks them up after hours and the stock will just go flat. Yeah, Microsoft has a potential to make reversals. So does Apple. Apple can drop, people sitting in the pre-market buying shares left and right will lift the stock back up. These stocks makes rebounds fast. They're such a monster companies. Now a stock like Amazon can take a hit to the downside. It stays down for some time. Same thing with Google. Google can take a hit, it can stay down for some time. They're there because when you look at earnings, there are a lot of stocks, they have the potential, like kind of like you could expect some sort of a reversal might happen. But there's some stocks they hardly make, they go down in one direction or they go up in one direction, they're just gonna stay there. Like Meta is gonna take a hit, it's gonna take a hard hit. When if it pops, it pops. But it doesn't fade the entire move down. It just stays there. It's like the way Netflix did. It popped, stays up. The post market is going until 7 o'clock. And then the pre market opens the next day and it just stays firm. Same thing what Tesla did, you know. So again, it's a wild guess. It's very, very hard to predict. But the point here is like the daily swings are down. What we need now is three higher bars. meaning for 3 days for the swing to turn back up. For these three, well, this is already good. So in order to find weakness here, we need to find weakness here first. Mag 7 has to roll over. This one is going to follow. Remember, I tell you that every week. You can't sit and fight this. This is an ABC. Okay, good luck. How are you going to make an ABC when you have this thing sitting up in north on your face? You counting a correction here and you have Qs and making highs near the highs. It just doesn't make any sense at all. You know, this is why I always says is that for me to fully rely on the wave counts are, I keep them as a 50-50 chance. I need this. Okay. I know what works. Swing is going to give me the confirmation, then I'll put them into a wave count. I can make a wave count however you want to see it. You know, I mean, here's the cues. Now, here's the August low. We have up in one, down in two. Now, here's the thing. All of these corrections that we had, this one, well, this was the big one. This one, 3.23%. You can count from here, 2.76. You can count it from here. The point is, if you're going to have any correction or a pullback, is going to get bigger in size compared to these two, the wave count will need to revise the wave count. Somebody was trying to uh, these degrees right there, they go from small to big. Okay, that's the way. If you want to look at this way, that's how it works. Smaller degree, one higher degree, another higher degree, another higher degree. That's how it goes. When you have a correction, your next one always has to stay smaller than the previous ones. If you're going to have a correction, the meaning that one higher degree gets bigger than your previous one, your wave count is going to get changed. What I mean by that, this 1, 2 right there is minor. So we need to make 5 minors to complete one intermediate degree, right? So if we have 5, it's 1, 2, that's your third right up there. You see it says right there, degree minor on the little banner. So in order to make the third to the upside, you need to fit 5 inside of that third. Okay. So the 5 that is going to fit this, which is this blue ones, is what you're fighting every single day, because you need to fit these 5 in there. This is more complicated work because you need to sit and count every single one of them. But if you just look at as a one, two, and says like, okay, well, I know that the the ideal target of a third wave, according to Elliott wave, is what? 161.8, right? Oh boy. Oh no, I took that thing off. Yeah, right there. 559. This is the ideal third wave target. Okay. From here to here. But that doesn't mean it has to get there. It can stop anywhere. But according to the Elliott wave, this is the golden ratio of Fibonacci. Elliott wave is 161.8. So you need to fit five of these blue ones, okay, which is this minute degree. The five of these minute will make this minor 3. All you're doing is just like you, five of these make one, five of these make one, five of these make one. That's how it is. It's a sequence. So we're fighting right now is 5 minute, which is these blue ones. So those five will make one minor. That minor is not even here yet because we're going to go up there. I don't have that the projections that far. So the point is like all of these, any correction, the market one sells off. So I don't sit and you can't do this during the session. You have to wait for the market to close. I know how much was this, okay? And I want to make sure any kind of a sell off or a day or two or three, the pullback or, the market sells off. I want to make sure that this side stays smaller than this. If it gets bigger, we're going to have a different look of the wave count. See, Elliott is a very well-defined principle, you know, but you just have to use it right. It will tell you where you're going to be wrong, what is changing. Okay. But it is a very well defined the way it moves, like the wave, how the wave structure works. Swings are different. Swings you could have fourth or fifth swing bigger than the second swing. That is totally different because that one, the swings are only looking for a bigger, higher highs and higher lows. Okay. The swing read on this one would be like this. So now this swing right there, if it's a third swing, it doesn't give me the downside confirmation unless it takes out this low. So you think it's easy to risk something based on this kind of a wide uh, 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 window that you have to the downside? So you stay long, take all the beating and hoping that the price is not going to take out this low. That's your high right there. That's your higher low. This is your higher high because why? Because it take out this high right there. Made a higher high. So the swings are different. The wave count is gonna give you more detail and is gonna help you manage your risk much better compared to a swing read. The swing doesn't go, I mean, it could stay down like this and it can reverse right back up because swing is all about you making higher highs and higher lows because that's the bull trend of a swing count is. And there's no limit on those counts. Could be 3, could be 4, could be 5, could be 7, could be 8, could be 9, 10, 11, 12. There's no limit on those swings. Elliott is you have initial move, you have your retracement down to 61.8 against your first move. And then from here, you either looking at the entry at 50%, 61.8 or 78.6. And then from here, you're looking for price to recover to take out this high. And then any upside that you get from here is where the price makes the continuation to the upside. Okay, same thing happens with the swing. Same thing happens with the Elliott. But as soon Elliott is starting to come, like if you want to do 1-2 swing, this is your Elliott wave. So you find entries here, 50, 61.8, and 78 point. You don't want to break. You don't want to go down to here. That's what it is. It's the same thing happens here with swing. Same thing happens here with the wave count. Now this wave two cannot go and retrace below 423. The wave count is wrong. You label wrong. You messed it up. Now you got to go back, count it again. Same thing here with swing. The two cannot retrace below where the swing started. So what are you looking for now? You're looking for entries here, thinking like, okay, I'm going to go and play this breakout. Well, the Elliott is telling you here, you need to break this one, right? And then the swing, it doesn't give in you any limit here. Okay. So most of the time, what we're looking for is two measured moves. You take a distance travel in one, project it from your higher low, and look for an equal 100% relationship. The distance travel here in one, projected from your retracement to a 100% measured move. That's what you're looking for. That 100% can go to your 161.8, which is a golden ratio of Elliott wave. That's where most of the third waves on any higher degree or a smaller degree ends at that 161.8. If the price would have a strong momentum to the upside, it can go up to 200% to 261.8 as well. So third can extend. That's what you have those fib extensions. Nobody knows where the price will stop. I mean, it could stop here, it can stop here. But the point here is this. What I like to see, and I hope it happens, we take this distance projected from this low, the 100% of this measured move is at 514. This is, I want price to get there at least, hit this mark. Okay, is to take this too. Then from here, because these are the two, we're talking from August low, and we're sitting what, almost in November now. Now you can imagine that how long a 1 hour chart can work for you. When you start looking yourself into those daily and those weekly charts and stuff, those will take years. Okay. Years to play out. You're looking for one bar on a daily chart, one session for one. I mean, you could have a 5 point session that just, okay, fine, that considered as a one daily bar. So what is your time frame on that trade that you're in that you're willing to hold based on that, based on the daily bar? And everybody wants to look. You can get that data from daily bar or the weekly bar. Weekly bars does definitely gives you a lot of clean, clear high and lows reading. But as soon as you're going to start coming down into a smaller time frame is where you're starting to see a lot of action. If you're going to tell me this, if the cues, okay, can drop, okay, from here to here, you think the market will be bearish? Just tell me that. If this price will come down here, okay, you think the market will be bearish? You think the market was bearish here? It was painful, but that doesn't mean it's a trend change. So the worst case scenario is like, okay, you can just picture this decline, okay, here. Just take two of these side by side. What do you think would happen? That will change anything? Absolutely not. This market had so much upside. If you need to put like a big damage to this market, you need weeks and weeks of selling to change, you know, um, the whole picture. I mean, here's a monthly wave count of QQQ when it was $19. How long you think is gonna take? Meaning, I'm talking these are monthly bars, monthly, 1 month, one bar. That's a lot now to add 4 weeks, okay, of 4 weeks of 1 month to make one single month. Here we are right now, right there. How many months of selling that you need to change the entire thing? Think for a second. How many months of selling? What would the catalyst would be that could happen? This market is on a very strong uptrend, okay? And it's the same thing here. Look at the bigger picture, then you can paint the smaller picture. Here's your wave one, okay? Here's your dot-com crash right there. So here's your wave three, right to that 261.8 we just talked about. So it can go to 100, 161.8, 200, it went up to 261.8. Look at the time of 261.8 in December of 2021. Matches perfectly here, right at the top. That's when the bear market started. This is the most cleanest wave count you will ever come across. An Elliott wave is on a QQQ. S&P is a mess. S&P is a mess. Qs are the best, is the most cleanest wave count right now. It's been this way for a long time. So this is a dot com. This is COVID right there. This is all of COVID. And this was a 2022 bear market. And how far that you are going up ever since from there. So my point now is if you have another 20% plunge to the downside, let's say because 20% is a threshold for a bear market. Okay. 5%, 10%, 15% consider as all corrections. Market corrects it eventually at some point. 5%, 6, 7, 8, 9, 10. It doesn't mean that, or it doesn't officially called a bear market. Bear market threshold is 20% from the peak. If you will have a 20% of exact decline, it will officially start a bear market. Okay. Then it will accelerate more to the downside. Because as soon as the market enters a bear market territory, right, it will start making more room to the downside because it's eventually called a bear market. Bulls are dead, takes over. So if you are going to suffer a 5 or 6 or 7% drop, does it change the entire outlook here? Absolutely not. But if you're going to be in a positions where you don't have enough time that you're going to take the punishment, is this what is where your emotions is going to kick in to think like, yeah, the world is coming to an end because this is the top. So these guys are who are sitting day and night and tracking all their stuff. It just there's no way you can tell there is a top here, first of all. Okay. Now back to Elliott wave. Now, if we take this and project it from our 2022 bear market low, the 5 versus 1 relationship is a 708. This is the minimum upside of a fifth wave is an equal 100% measured move of these two waves. Wave 1 and 2 and 3 and 4, these are the counter trend moves that goes against the trend. Wave 2 was deep, was steep, went all the way down to 78.6, but it didn't went below 1976. It held, made its way up, took this high, climbing all. I mean, it has several dips here. I gotta, this is the big one. That's the big one. I mean, there's a couple dips here. A couple months of selling here, COVID, right there. But here's your channel. You take this to connect because this is your .com low. This is the bear market low that we just had in 2022. Oh, 22 or 23? Sorry. 22. That's what I was thinking. With October 2020, October 22 lows right there. 250. Now it's at 494. So the point here is when does this fifth wave ends? The only thing that I've been watching because this is a monthly chart, I know it's going to take a lot of time. This is what I'm watching. This, you know, this blue fib. I know a market is trying to push and clear this one. You see, like it hit the, hang on, let me show you this way. Because this is that golden ratio that I've been talking about all this morning. Right there. It hit this mark here in June. You need to pay attention to this fib, how it picks bottoms and top. Just pay attention to this one only, the blue one. See the low here, the COVID low, 2022 bear market low, market where this where it started the bear market high. This one is sitting here as well. You see, it hit the price on June. On July, it went up to 503. 503 for 479 went to 503. It made a higher bar, and then it reversed. See it back off. There's something is about this. This is where the price is fighting right now. The only confidence that I am seeing that makes me stay bullish and is first that I would like to get to 708. That will be my ideal target to the upside. It's just to get a measured move of this one matches with this fifth wave. This one right there does look more impulsive motive wave. It doesn't have a look of any sort of a diagonal look. That would have a big overlaps, meaning like the price would have contract. It doesn't have that. It is a much more clean directional move to the upside that kind of looks like this, right? Because the fifth wave is considered an actionary wave, so it's going to be more, it's like a motive wave. So now it's a 494. So it's trying to clear this hurdle, this 480 mark. And then the next one is 548. That's what I have. And then I can throw a bunch more. I don't want to make the chart messy. I just want to keep it simple. I have this yellow zone here. As long as we stayed within this trend, okay, I got the timings all here. That's for the top. That's for the bottom. Expecting a top here, that's just the time relationship of that 5 versus 1 is to complete a 5 wave. Now, this fifth wave can extend, okay, as well. There's no sign. Whenever it can go to 5, 3, 5 plus 3, I mean, I can throw a bunch of wave 5 up there, but I don't have to do it that. This is still, you're talking 43% upside just to get to that 700 mark, 43, 44% upside. So if you calculate, let's say, a 2 years like each year average of tech is like what, approximately, like if S&P right now is 20%, 21%, Qs are close to 20. So this is approximately, I think, for like another 2 more years. If you just take the percentage average, take the 20% of average per year and take that 44%, 43, 44% just to get to the 700 mark, it's the 2 years worth of price action, right? Just guess that number, put them in your head. And I'm not saying that we're just gonna, will be just a clear. I mean, you have to look at this with that how much of a return then you have to go to a data. You have to study the data to see what kind of a returns that you expect from over the years. So if you take, so now these, because the thing is this, that these are all projections, right? If they call fib extensions, you consider basically price projections. Anything looking down is due to retracements, because market is pulling back, you're looking for retracement. How much does it retrace? Retrace 4%, 5%, 6%, whatever. Then you draw your fibs. The fibs are giving you those Fibonacci levels, is where the price could find a potential support. Then we draw these boxes, the yellow one and the green one. Should have changed this one to green. So the green is our target zones, and the yellow ones is where we pick our entries to go to the green box. So this is all good. I'm not worried about this. I don't have to change this thing at all. I'm not even labeling. You see how I left it all blank? You see that? I have nothing labeled here since the low of the bear market. And I'm not going to label anything here either. I don't have to. Okay. So I take this price data from here, okay, and bring this thing down into smaller waves, so smaller time frame. It's the same thing, but instead of looking at a one single bar, which looks much cleaner, if you ask me, because if you make a wave count like this on such a high time frame, you don't have to do anything for the next 10 years. It's gonna take a very long time to complete. But is the fifth wave ends here? I'm just saying, can a price stops in the middle of a channel, okay, and it just rolls over? I mean, it normally hits the Elliott wave technique is, okay, the channeling technique that Elliott uses is when you connect your 2 and 4, and then you project that one with your 3 top right there on the third wave to the upside. Your fifth wave hits the top of the third wave. Okay. Elliott has a very good channeling technique, but most people don't know or don't use them. So I have this is what my long my long-term upside target of Qs are for now. But if we will get to the 700 mark, then we'll see how everything looks. I mean, we can come back down. It doesn't matter how we do, but the point is, like, as long as it has a motive wave look, okay, a more directional move, the wave count is fine. So what I'm trying to do is basically what now, here's the thing. Um, the largest correction of the entire move up that you have from 20 bucks, one was your .com, which was 54%. And then you had this bear market of 38%. Okay. Because your COVID decline was only 30. So your two major corrections of the entire trend, okay, it only happens where? In a wave 2 and 4. I mean, it's just such an easy, like, I'm not saying easy, but like, to remain bullish, to be stable. This year was, I predicted this year last when S&P closed last year in inside bar. the yearly bar, I was like, 2024 is going to be monster, because you close in the entire year in an inside bar. And then you're going to have a 2024. And as soon as you're going to take out the high of the inside bar, you're going to extend. You're going to make room to the upside. That's exactly what happened. Now, the point is that I'm going to show you something. Hang on. I know some of you guys are throwing some questions. Hang on. I'll read and I'll forget. Every time when you break, oh boy, what's going on? This is your largest decline of the trend wave. When you have a bear market for such a long, not bear market don't stay for too long. Bull run runs for a long time. Bear market don't stay down for too long. Um, the point is like when you take out the bear market high, but meaning that where the largest decline was, you're gonna make room to the upside, and you're gonna spend a lot of time going up. Okay, if you have a 30% drop or a 40% drop or a 50, 60, 70, and if the price doesn't recover back up right back to this high, okay, if it backs off, that just gives you the sign that it has a double top now. When you have a double top, market don't tops, the meaning that forms a top with the double tops. They're gonna get taken out at one point. Triple tops. There's no S&P, um, um, Dow, NDX, Russell has formed a triple top and where they have their largest percentage decline. Show me one, because I like to see it. Market just peaks like this, and then it will make its footing to the downside. There's no double, triple tops, and then you see the largest decline. So, anyways, the point is like the two biggest corrections do you have in the entire trend is always in where? 2 and 4. So when you use your degrees, okay, this is the cycle degree, okay, is because you now you need to keep your all of because your cycle degree retracements, okay, are bigger than all the smaller ones that you have going up. And because I just measured those ones for you. All these ones that you have, okay, they're smaller than this one and this one, right? This is what is gives you, remember, the most important part of a wave count is to have the right look. Okay. Your wave count must have the right look. If you don't have um, a wave count that doesn't have the right look, it's not going to work. Okay. So it's the same thing that I'm trying to show you here on a smaller time frame is this is the same thing, but here you only see 1 or 2 months of bars. What I'm trying to do is I'm trying to take this price up to the 700 mark, and I'm going to do it on this time frame. Okay. So because I didn't project that one because I will be very, very close because this is going to be that third that I'm trying to do. And then you're going to have this fourth wave. Now this fourth wave will have the same relationship with this four too. Okay. So that would be the 7-8% drop. This was 7.66, call it 8%. Okay, so it's gonna have anywhere whenever this fourth wave will unfold, will have the exact relationship with this wave two. It depends how the fourth will go. Okay, could be a flat, zigzag, who knows? We're not there yet. I'm not worried about it. So the point now is, okay, is to take the distance travel here projected from this low. 100% relationship is at least a 514. We cannot leave this thing here. Okay, and I can't put 3 here because I don't have enough room for this 4 to breathe against the 1. It has to make room to the upside. Okay, you see how Elliott works? So the point now is that the price has to at least reach 514 because your wave 3 cannot be the shortest wave. Elliott has a rule, right? Third wave is the longest wave, but it cannot be the shortest wave. The shortest wave meaning that it has to at least get to a 100% relationship. If it falls here, meaning that if it stops here, let's say 510, and if it drops, first of all, if it gets to this, you don't have enough room here for this 2 relationship to work with that 4. That's one thing. Okay. Second thing is this, if you're going to have a shorter 3, you're going to have a very teeny tiny 4. Okay. You're talking something like this. Let me show you this. So this is your wave 1. This is your wave 2. And here your wave 3. You don't get to a 514 and you stop right there at 503. Okay. So here's your 1, here's your 2. Now you know, okay, your wave 3 is shorter compared to 1. That's one thing. That's not that's first of all, that's not even right. Okay. To even have a wave count like this with a shorter 3 compared to your 1. Then you gotta do is you gotta put a stop loss right there in validation of your wave 4, and then you need to look for this wave 4 to breathe. Cannot go below this 1. Okay. And then let's say it happens to find wave 4 here, and then you're looking for wave 5. Look at the length of this wave 5. Now you have a shorter 3, okay, which has a no relationship with any one of these trend waves. Now you have this 5th relationship that is going to come with your wave 5. How are you going to make this thing work? And how your wave count is going to look? It's not going to look right. This is why any smaller wave 3 against your 1 is going to have a very hard time and very difficult to measure the upside. It's just not going to work. If I tell if it would have worked, I would have known by now. Okay, I don't need to figure out Elliott wave, which works and which doesn't work. I figured this thing out years ago. So I'm just trying to teach you and trying to make some points for you to understand how this thing works. But for now, I have, remember, we want to get to 700 mark. But on 700, we're going to have several hurdles. Okay. Here's your top, 503.52. We didn't hit the top yet. NDX did yesterday. Q still got room to go. Now, the thing is this price where it took 16% drawdown, okay, to August lows. And now the price is pretty much recovered all the way back up. Even the fact now, the worst case, okay, is this. Now we're gonna look at things every different ways, okay, not just from Elliott wave. So rules are rules. We cannot break them because we're going to be wrong and it's going to cost us money. Okay. We have a wave count as long as it's going, meaning that all of these dips are staying smaller than the on a one higher degree, meaning a smaller degree. It's a small degree because now you need to fit five to make this three. Then you need this four, and then you need a five because we need to fit five blue ones to make this third. So we could go to at least, but we need to get to at least 514. If the price fails at 514 and slightly, that if it makes a little bit more push to the upside, I'm totally fine with it. I can just move this thing down here to third, okay? But you cannot expect or think anything because you need some sort of a couple days of selling for you to make a case of this fourth wave against this one, you know? So you just think in several waves like already ahead of time. That this is not how it works. You have to take one at a time. Okay, you just as long as the prices keep making higher highs and higher lows, you're good. Okay, so this is low right there. That's your high. You see all these dips that the market has, they're all smaller than all the other ones. Okay. So for now, what we can so this is one of 514. Now we'll take our first wave with of that three with this wave two. Your minimum upside of this projection is at 525. This is why I have this green zone. Okay. Is where I'm looking for price to get there to this green zone eventually. I don't know how long it's going to take. I mean, you can just go sideways. We just end the year. We just gotta have to kind of make some adjustments. Okay. But if we roll over, okay. The other thing we can do is this the wave count is gonna give you a more detailed work, fibs, all that kind of stuff, right? That's all the good part. Second thing, if you don't want to waste your time and thinking like, well, I don't know how to count things like this, you can just simply look for handle to form if there's going to be any dip. Okay. So this is already a round bottom. Okay. It's just a matter of if the round bottom just gets taken out straight like this, or it comes back down, is to form a handle. Okay. So in order to form a handle, you need volume. Okay. That's very important. So the next 2 weeks that we have coming up, earnings and elections, we're gonna have a pretty healthy volume, right? So if you don't want to sit and, I mean, I can give you these fib targets. They are more precise, like more well-defined targets, like as you support and like these, like I'm a master of fibs. I'll give you all these prints because this is you can position yourself and you can look for the upside targets. Is your take profit zones as well. But it's just how I see it for now. I have a wave car. I'm gonna leave the way it is. I'm not gonna change anything. It's in a well-defined channel. Okay, I can see it. Corrections are all smaller than one on the previous degrees. And at the same time, I'm just gonna keep an eye on this. Okay. So the worst case is like if the market sells off, okay, in a Mag 7, we got a couple surprises here and we're starting to back off like this. I will be still viewing this thing as a really, really great buying opportunity into that 38.2 to 50% mark. Okay. most of the time, the handles form between these two zones. Okay, so meaning that this move from here to here, okay, you just look for that 50% retracement is where the price will eventually come right back down. But you need a volume right there. Volume is very important for a handle to form. And then from there, that's going to be, you're just going to take the full depth of this entire move from here, okay, like this. So we're just going to measure August low to the high, projected from the handle low, 50, and then we'll look for 100%. So you can sit and think market top is in and this and this. Okay, good luck. But there's no science for it. There's absolutely do not have any science for it. No tops of market has ever formed with double tops. When you take out the high of any price chart, you look for further continuation to the upside. You don't just come down. This is how the price works. You don't come down 30%, go up 30%, put a double top, and then come down 30%. This is not how price works. Never did. Most likely ETFs and none of those index will ever work. This is not how price works. It doesn't make any sense. You don't come down 30, go up 30, forms a double top, and then come down 30. Okay, so if you're doing this, what do you think is going to happen? 30, 30, 30, and then 30. So you're making a triple top. So triple top, what do you think? That thing's not going to break? Look at gold. How is it ripping after 3 years of consolidation? This is, if it gets like this, it goes into a consolidation mode. That happens when you have an uptrend. Price went sideways. What do you think happens from here? Price find its way back to the upside. That's the pause. That's where the price consolidates. It doesn't matter. I'm not, I'm bullish. I'm staying bullish. I don't have, my screen is not telling me to go bearish. There's no signs for me. And if I see it, I will definitely let you know. But I mean, I'm a buyer on any weakness. Just, I mean, well, I'm talking about depends on what you're looking to do. I mean, if you take in counter trend move trades here, there, that's different. You don't have to worry about um, these big massive upside. I mean, if you're looking for 3, 4 point, 5 point moves per session, that's different. You just For me, you're just literally wasting your time studying all this. You don't need a wave count to make a 3, 4 point move. It doesn't make any sense. If you're looking to play a session moves, I'll give you those levels. You can play those all day. I can give you a well-defined low where the price can find a can bounce. You can look for 4 or 5 point move from there. Or I mean, if this is different world, the different stuff that you're looking for. If you are looking for a 5% move or a 6% move, this is where the thing is gonna come into a play. So if you're remember, market is forward looking, right? It's always looking 6 months ahead. It's 6 months ahead of us. I mean, we're just going into this election in the next 2 weeks. Market has already passed election 6 months ago. Think about it. 6 months ago. I already went through election, was just coming in. That's how far ahead market is. So you always have to think that far. Well, that's how all these hedge funds guys they position their portfolios. They cannot, you cannot sit and think based on today's market. You just it doesn't work that way. If you're managing money and you are that's what Elliot is it helps me that if my wave count is right on a certain time frame, I have my price projection and then I can buy something based on time projections using those fibs, and just leave it open. If I have shares, I have nothing to worry about. Because the nightmare is all about options because of the time, you know. So the sucker has to move as quick as I can because it's gonna cost me time as long as I'm gonna hold those premiums. So it's important. You gotta pay attention. What do you do? Where you define your risk? How long you plan to stay in a trade? If the trade doesn't move, should you reduce the size on your trade? Should you hold it? So there's some decisions that you have to make. There's a lot of time. Mark is trying to take a pause. I just reduced the size in the position. I was like, screw it. I don't, first of all, I'm not, I do trade single trade options, as you know, swing couple calls here, but most of the time I trade spreads, if you notice that. And and I like spreads. I learn options from spreads, and you should do the same thing as well. And it will it will keep you very disciplined, and spreads are really, really good to trade. It is a very well defined. It tells you exactly what the premium you're paying, exactly what your upside max profit would be. But the only thing is the same thing doing a covered calls as well. So you give up the upside. So like you risk $1,000 trade, like you make $1,000 spread. If it has a $2,500 risk to reward, like meaning that you have a potential to make $2,500 max profit, but you're risking 1,000, that's a pretty good odds, right? So if you even make 500-600 bucks out of it, that's almost 50% return on $1,000. You know, just it adds up. I mean, somebody was like, oh, some guy yesterday was telling me, it's like, man, this small number adds up. I was like, of course it does. You know, don't look at those big jackpots. Those, how often those comes? Because everybody had their, like, look at this, 450 here, 379 here. Look how it adds up to 5 grand. They're little, which is, I'm fine with it. 440 here, 165, 575. Oops. Um, 300, 370. It's a loss here of 730, 732, 525. Look how fast they add. But you just don't look at because you have to journal all your trades. This is how you grow slowly, you know. You can take a hit as well, give back 500-600 bucks back. I mean, which is fine. But the point is like these number adds really fast. Well, now if you want to sit and say like, well, I want to take a $10,000 position, I want to make 5 grand in one single trade. Yeah, you can do it. You got to take 10 grand risk. I'm not taking 10 grand risk, not on options. I don't care how beautiful looking my wave count is. I'm just I don't play the market that aggressive. I'll trade every day. I mean, I open 15,000, $2,000 here. I open 3,000, $4,000 on my account. It's the same as a double the return that I have on my end. I'm fine with it, you know. But it's if you double every size, you double the profit. You triple it, goes to 15,000. It's a simple math. It's going to add always right. That math never going to add wrong. This is just, it's not just focus on percentage. What you paid, what percentage return did you got on your money? That's important. That's what matters. Market returns are not being measured in dollars. Okay. They're all measured in percentage. So everybody who's looking for returns in this market is based on percentage returns. Okay, here's a quarterly so far. I mean, we still got a long way to go. Okay, so we have a higher bottom quarter. Okay, which is the last quarter. Remember, so we have a higher bar. So is this quarter can go flat, can come back down? Let's just study a quarterly bar. Most probably some people don't even look at quarterly bars because most people are only stay here, buddy. What's going on? Most people are only look for daily, weekly, and whatever monthly chart. It's a quarterly bar, meaning for 3 months makes one bar. So what do we? Okay. So here's a quarterly bar right there. So in order for this quarter to to engulf now, meaning to put an outside quarter, we need to go down to 510. Already made a high. So you're looking for just mark that thing on your price. So about 579 right here as of yesterday close. So you take 579 to 510, that's 11.87% drop. If that happens, as kind of what it's going to do is that your entire quarter, so you basically, okay, now let's do math. We have 2182. So we have 2182 minus 11.87. That left S&P at 9.995%, which is 10%. So if S&P drops 10, 11% from here, that means that you have to cut down all of these ones. Okay. So this one goes flat for the year, IWM right away. If this thing takes a 10% plunge, this one is going to go negative for the year. So does Dow. It's going to go negative for the year. Okay. So think for this way. Okay. You have to, when you study a data, that's a different than Elliott wave and the swings and all that kind of stuff. You just always you can get a lot of information from it as well. But if you have all this data in front of you, okay, but I'll show it to you. This way you will have a pretty good idea, like, okay, what I could expect in a worst case scenario, right? So we're 579. The 579 for us to, because this bar right there is going to stay green. Now it's just a matter because it took out this high right there, right? It doesn't matter where to close. It's going to stay green now because we don't have a lower bar. It's for this quarter. So quarter has, this month is gone. So we have 2 more months to go. So this election is coming up. Okay. Worst case that the market took a massive plunge all the way back down to 510. So this is going to be an outside bar. 100% I'm going to buy 510 level, if we're going to get down there. Because then if the bar is going to turn blue, it's just going to close blue for the entire quarter until the year end. It will just chop around. That's it. Okay. So your year is going to be pretty much toast if this thing turns into an outside bar. So you basically expecting or hoping that we're going to have 11% drawdown. 11% drawdown is going to cut. So you have to take what tech is. If this thing is going to be 11, tech is going to be more. Keep that thing in mind because tech is a high beta. Sorry, it's 20 right there. Yes, same thing. So tech is going to be more, right? Because it's a high beta ETF compared to the SPY. So you got 20 here, 20 here, and you're gonna have 10 here. So you are telling me that the entire year that we just run to the upside, and you're gonna give everything back in the next 2 months and to go flat for the year? I don't think so. It could happen, but I don't see any odds for it to happening. I don't see 5, 10. I mean, to give. So you rally all year long and to washed everything out in the last 2 months. I don't know when was the last time that ever happened, but we'll look at the data. Cycles does not make me think to make that kind of a case for this drawdown from here. So I understand that the only thing that kind of makes me a little bit of a I have a little bit of a concern, okay, that I'm watching is this that we have four straight, I mean, it's not over yet, that we have four straight quarters. That doesn't happen that often. That's rare, meaning that we're extending. I mean, I was hoping that the Q3 is going to be a slightly negative, just to have at least read that the SOC did 6.79, 6.91, but S&P just eventually just ripping right back up. So Q3 was stronger than the Q2, and now we're right at that 1.83%, SOC 2.2. So this is a whole month, basically 1 month so far. 2.43, 2.9. So this one negative, Dow, because it took that 5 days beating. We still got 4 more days to go. So it just most likely it's just gonna stay flat. But the point is, like, sorry, this is quarter, so you still got 2 more months to go. IWM is flat. This is flat. Transports are over 2%. Qs 2.9, 2.4, 1.8. So on sectors, flat. Healthcare down 3. XLU, utilities had a monster last quarter. I think it's going to take a bit of a breather. It's up pretty strong year to date. Real estate. Now, real estate is a little bit tricky. So you have a down quarter, monster quarter in Q3. We picked it up. Um, that one. And now we're just lingering, sitting on a flat line. We're up 10%. I mean, the rates, we're going to look at them in a second. Consumer staples down 2. you know I mean, XLK has your technology 4.5. Since you have an XLK 4.5, that's 2.92. That's more. It's almost double. Industrial flat. Financials are up. Okay. And communication is strong, but it's flat. It's waiting for that meta. Okay. But here's the thing. Okay. When you're going to start, pay attention to this data. When you have two down quarters, that's the quarter in the end you buy for the third quarter. Follow me? Back to back 2 quarters for any sector is very rare. It doesn't happen that often. So remember that. Okay. Like real estate was down here. Then the second quarter, that's 6 months. It's easy to say 6 months from your mouth. You know how much time 6 months? That's half the year. A sector is down. Then to see how it went up, 15.85%. It doesn't happen that often. Just remember that. But when it does, and you happen to come across, I don't know if you're not gonna have this data, but you have to go individually on Yahoo Finance to pull it up. But if you happen to come across an ETF of an S&P 500 which has 11 sectors, okay, which are down, if there is any sector which is down back-to-back quarters for 6 months, it's going to have a very high big pop on the third quarter. Okay, anyone has to be down. Okay, so it happened only in real estate this year, and I hit a trade on that American Tower based on that. It was like time to go long. This doesn't happen that often. Anyways, so now the thing is this, you see, this is what a little bit of, we have 4 quarters. Are we willing to close 4 straight quarters? S&P and QQQ and communication and technology and communication. These are the only 4 that we have this year. Okay. We're just assuming the fourth quarter because it's not over yet. Okay. But I just want you to remember where we at, because every other ones has red quarter in there. This one does, this one does, this one does, this one does, this one has, this one has. You see? This one has one. Energy right now is almost flat. See, energy was down for 2 quarters. This is why I went long energy yesterday. And I like to stay long energy this year. Sorry, this last quarter. I'll get to the point why I'm long. I was looking at all these things. I was sitting quiet yesterday for some time because I need to focus. I need to think. Clear. I'm no talking. I need to focus. Um, I'm I want to stay long energy this quarter. Um, I understand that the the energy is not spiked up because we're right at the peak of election. Because remember, it's a fixed market. Okay, just I know I always mention this thing, and some of them you just laughs at, laugh at it or whatever. It's been the way it's been programmed or it's been controlled. It's pretty well whoever is doing it. Okay, let's put it this way. They just, I mean, the energy is 7%, which is fine. Okay, it's up. It's almost flat so far, but energy closed the last 2 quarters down. Okay. And I know we are filling up our reserves as well because we use our reserves before, and now we're, because we use those reserves to push to put the gas, oil price down, and now we're filling up our reserves, and we locked our future contracts where we bought the oil, and we're filling up our reserves, and that lock right there on those future prices are are are, are set, right? And at the top of it, we have this election because of the inflation and stuff, because a normal people that all care about the gas price is going to be. I'm not saying that the oil prices is going to go through the roof. I mean, could anything could happen. But now these wars or whatever this action is going on. I mean, you can see how fast the market respond to it. Oil goes up, Bitcoin pukes right away, oil pops, and gold goes up. So energy is something that I am a little more interested in Q4. But the same time, we have this earnings are coming up, and I don't expect a massive spike or big pop, right? 10 days before election. I mean, anything can happen, but I'm sure they're gonna control. They watch these oil prices and bond, like closely. But betting on oil in the Q4, if because XLE, okay, XLE is the energy sector, is a defensive play, okay. So defensive is like, oops, I'm gonna do this. The Where is here? So this is a defensive sector. And I'm sorry, it's considered as a growth. You can do growth or defensive. This is the only sector that makes me or make everyone confused. Okay. XLE, like, because when S&P had a 2022 bear market, right? Energy was the one who's already, the oil went up and all that stuff. So I had him at a growth for now. I can move him here, but it's the same thing, I mean, it's always energy is always a big question mark. Where does it really actually fits in? Is it considered as a part of growth sector, or does it consider more as a defensive sector? Defensive sectors are the ones that are more they performs when market rolls over, right? So your defensive sectors are healthcare, consumer staples, and utilities. So, but at the same time, when we see the spike in oil and something happens, that is considered as what? Defensive, right? So it's technically considered here, but doesn't matter. I mean, you can put it here or here. So that's the one that I am willing to play. Second thing is, no. Second thing is this. The heck and when my sectors right there. XLE right there. XLE just pulled back here in the second swing. Okay. And remember, we just looked it up. That is up 7%, right? We did our wave count on the XOM. Here's a swing we have in a second. We're looking for a third. Okay. And this little red line right there, that's your 200-day moving average. You see where the price from the last 3 days is fighting this one. Because if you look at the S&P right now, 11 sectors, every single one of them is above the 200 EMA. This is the only one is trying to fight her life to stay above this 200 EMA. That's a pretty strong support every single time when the price is going to come back down to 200 EMA. Everybody knows that. The price came back down here, tested here, was pretty close to this. Yes, that's when I pulled the trigger on this XOM yesterday. So let's go long XOM to see if we can defend this. XOM follows XLE, their husband and wife. Okay, so it's the strongest stock in the sector. We already looked it up. Okay, so I was like, if XLE is gonna move, it's gonna push the Exxon Mobil first. So we'll talked about that thing before. So we don't need to go there again. The only thing is this rotation of energy of this second swing is confirming this weakness here, which I like to see that, which is really good. That's how RRG is supposed to work. Lagging quadrant here, you either gonna have a second swing down, or you're gonna have a fourth swing down. Okay, after third, you get the fourth swing down. Or it could be any counter trend move, but the weakness has to confirm. It doesn't really form this kind of a hook like this. You see, it's there, But we'll see on Monday and see how it happens. And if the price starting to move like this, energy can turn around like this. But the point is like this weakness right there toward this 200 EMA. This 200 EMA is what we're trying to defend to see if we can get here. We can poke below it, but we have our zone here, which is I'm going to be watching this yellow one, 89.93, 88.61. This is a zone that I'm going to watch to see if this second swing can manage to find support here at 200, give our fibs, that's our fib zone, along with this, and stay long XOM. I could buy XLE as well, but you gotta size up the trade like crazy to buy XLE sector just to get the move back up. 3 point move, 100 delta is 300 points. I gotta double, triple delta. I almost gotta play like $300-400 delta to get like, you know, a 300, a 3 point move. 3 point move for 300 delta is almost $900. So I gotta have to think that way. That's why sometimes it's a little bit harder to you can to trade sectors, but from the same sector, if you pick that leader, you can get a lot more alpha, you know? So I hope you get my point. You always trade the the strong names. They're they're strong for a reason, right? But if you wanted to fight your life with your 1, 2, 3% market overweight stocks to the end to the sectors, yeah, good luck with those. You know, they can move, but you don't they don't move as fast. It's like the same thing with like Nvidia or Apple and things like these stocks. These stocks drop, but they're gonna recover pretty fast. You know, so just remember that. Very you have to study. I mean, you guys have all the time in the world. You have to sit and um, just spend time on this website. It will improve your trading and your decisions. Everything is here on this website, sectorspdrs.com. They have a pretty cool mobile app as well. You can download the app as well. Very underrated website, but whoever you see can download an app store, get on a Google Play, and they don't even have 2276 followers. They don't even have that many followers. Very very nice. Really, really like this website. It gives you earnings. There's your earning calendar right there. You can do a full calendar. There, click right there. See October. What do you have? October 26th. There's your third. See, it just narrows it down for you. Everything is here on one page. It's a beautiful website. October 34th, there are going to be 34 companies, 39 companies, 4 companies are only reporting here. You know, so you can just go to the next one, 4 here, 41 here, here. Your AMT, Google, Electron, you can just, everything is planned here. What else do you need? 56 here. Here's your meta. It tells you right away exactly what stock it is. It gives you exactly sector, but the stock is going to be impacted on. You look for a sector because that's going to be the heavy name, right? That's what it is. Right there, it gives you the index overall weight. Look at Meta, 20%. What do you think it's going to do to the sector? You have 20% weight on the sector. What do you think it's going to do to the market? It's going to move the market. I mean, it's all here. There's their EPS estimates. It's 51 of them are going to report here. It's Amazon right up there. There's 22. Lindy, right? That's your material. XLB. It's a huge company. Huge, huge company. There's a Southern company right there. SO. ConocoPhillips is a big one. MasterCard. I mean, They're all here. It's very, very good website. You just gotta um you just gotta have to sit down and study it. Just go through because every stock that you're trading, okay, it's all here because it's been divided into 11 sectors. So any stock that you have on your options or on your um, uh, whatever your holdings are, it's all here. So you need to look for a sector strength or weakness to look for a next potential trade or next potential investment. That's what it is. Because I mean, I have mine um, performance, but you can do it here as well. Last quarter, year to date, 1 year, 2 year, 3, 10 since inception. And what else do you need? Look at this. Market value, total return month end, pre-liquidation after tax total return month end, net asset values, as your S&P chart, year to date. You can compare as well. You can do comparison. Like, okay, so this is your S&P, right? Select sector XLY. Here you go. Now you have XLY and X right there, both side by side. S&P in black. Here's your XLY up on the top right there. So that's the 1 day. So you go to 1 month. So what do you see? You see S&P is higher, XLY is down, meaning what? The sector is underperforming the benchmark. Okay, that's how you look at your your. Um, Now you can do energy. Energy is outperforming S&P 500 so far. See, the green, the yellow line is higher than the black one. That's what you look for security. Which one is outperforming? Which is underperforming? It's all here. So sit tonight and go through this website and do technology. It's going to be the same because the tech moves the S&P. Financials, look, outperforming the benchmark. That's how it works. So you could do Apple. So you could do Apple as your S&P. So if Apple is going to start moving higher, you have to look for these divergence. See where there, right there, like this. When you happen to come across this divergence right there, is when the stock is going to outperform the benchmark. The S&P is when the stock is going to move. Okay, you can do any stock here. Put the Tesla pig in there. There, I just passed above it 2 days ago. So you can always find strength and weakness this way as well. I'm just showing you this on this website because I have more fancy charts. So those are those are different. I can get lot more data here. But for you just to, because you don't have them, you can use this as a hint. If you look for a um, if you're looking for a stock, you wanted to buy something, come to this website. Or you can do it. There's probably many. You can do this one on Toss as well. Let's see if I can show you on this one. Doing this one as well. What do you want to do? Tesla? No. Let's see if we're gonna do Tesla. Oh boy. This is from yesterday. Clear this one. So you want to go to daily. You can do this thing on a toss as well. And then I believe studies, load studies, compare with S&P. Here. So now you have an S&P right there on your left scale. That's your Microsoft here. So the S&P is outperforming. So it's underperforming the benchmark. See? Because Microsoft not really doing anything since it took this dip down in August lows. It hasn't really recovered much ever since, you know? So you can do NVIDIA here. So you can keep the same line, like you can do the same comparison, but you just keep changing the tickers here, you know? So you could do MSTR. See? MSTR is because they split the stock. So it's going to show you some of the, as your coin. See, like this one is definitely showing as your S&P you're trying to compare with. You can change it to any, you can do bar. I would do line. Line is always better because it shows you the exact close. It doesn't have those spikes like the high and lows and stuff. So line chart's always going to give you the most accurate data on the price. People don't usually follow line charts because they use them mostly for data. Um, so you could use this one on toss. They have some, I don't, they have a bunch of studies. Just right click on the chart, studies. They have a quick studies. Oh God, boy. Add study. Yeah, and then right here, compare with. So you could compare as an S&P, semis, it's a 100 sector, NASDAQ, mini, CBOE right there, composite. So you can custom something there. This is only if you have a thinkorswim. If you don't, then you don't have this. You probably have to check yours. So it's just, I don't know. There's so much stuff that they add them in there. I don't even know what is that. So this is something you could always look here. But this one, we'll talk about this, is something to watch. Um, Here you have 10 years in blue, right there, 4.21. I have IWM, change this color to red or something. IWM here is in green, okay? And then the treasury bond, the TLT, is in red. Look what happened here. You know, now we're gonna go back. Let's do yeah, it's not gonna show because of divergence. Well, every time when you have, they call this is called an overlay. Overlay is when you have divergence between two securities. This is one is gonna start moving against the other one, right? See, here is where we had a divergent happen here. Is when 10 years went down, IWM took off, so does the bonds. See? The funny part is that you see this drop right there. This drop right there on 10 years didn't line up together because this is where we have our August lows. Is because the broader market sold off. NDX was down like 70, 16, 15, 16%, I believe. And S&P was down 10%. So when you have that 10%, 15% drawdown, well, of course, IWM is not going to rally. This is where the rates sold off as well, right? Now, so this year, meaning the um, last year, the IWM was been like this is the 10-year rates going all the way up here. This is when the green line and the TLT, you see how it tracks from here. So your TLT was down, and so does the IWM because higher rates hurts small cap stocks the most. It's all the regional banks and all the other ones. And rates topped out here, starting to back off. IWM took off, made the divergence, went back up. And look what happened here. This is where everybody was like, the Fed is going to pivot and this and this and this, right? The rate cuts are coming. And now everybody is going bullish on small caps. I went bad longs right there in March. Do you remember? Right there. Oh, shit. Right there in March. So went up here, there. Look at this, what I've been doing ever since. Fucking look at this. This is the trade has been so far since the March that I bought those shares. It should have stayed long, small caps. You should have small caps on your account all the time. You can get 10% return on it. It pays minimum 10% return on average. Keep collecting 10% every year. So now this is a little bit concerning. I don't know what is causing this move in 10 years. Okay. That pressure, this dip right there, which was that 4.2, we just looked at it on IWM, and these rates are moving up right into the election. When you have a higher rate, 10 years, okay, that means there will be no more rate cuts. Fed already cut rate once, right? They're not planning to raise rates. Europe did three. So does Canada. All the other countries right now, they're cutting rates. We're the last one who cut the rate, and we only did one so far. Now, at the same time, I know the election and all the other good stuff is coming, but what is the spike of this move and this divergence that just happened? Is a little bit concerning, but we're gonna watch. I'm watching, and the 10 years, which was down here, because this here's IWM right there. So the IWM right there with this 10 years, this gap right there you call spread. Wider the spread is, which is good. Because if the thing is this, what this overlay, what it's trying to do is they try to climb on each other. Eventually, at some point, they will. That's how this correlation works. It's set apart, okay? They stay apart for a long time, but then eventually they're gonna come back and cross each other. So it's okay. I'm not worried too much. I mean, I understand it's down four, which is fine. I mean, it was down here as well. So this is not there's nothing special here that doesn't happen here. Okay, so it'll be okay. What I'm watching is that this is they call a spread. Wider the spread is, the upside momentum stays in place. If IWM makes a divergence back again like this, you see how IWM took off and 10 years went down. It's the same thing. So it already made a divergence here before, right here. So when IWM went up, 10 years went down. So when you're gonna have the next divergence happen, the 10 years is gonna go like this, and IWM is gonna come down like this because they already did this. Okay. So that's how divergence works. That's how the overlay works. So the spread is quite a bit, but I don't know if this 10 year, because the 10 years was right there and IWM was barely took out a double top, and it just kind of looks like a little failure to this, like a triple top failure, to be honest. Because if you take all this highs right there, this one right there, it definitely looks like a more like a fake out. You see, like you took so many hits to the downside and you barely took out this high and you just reversed all the way back down now. This week was brutal for IWM, you know? This is a fake out. So it hardly managed to break and it just reversed. It doesn't matter, it can make another attempt. Now, yesterday, the little hook right there. So there's still a quite a bit of spread left between them. You don't want to come too close. The closer it's gonna come to each other, that's when they're gonna cross each other. So you want to stay apart. Okay, so we'll keep an eye on it and see how the what happens to 10 years into election time and stuff. But this is a little bit of a, but at the same time, the, uh, the 10 years put pressure on this, but here you have NDX is making new highs, 52 weeks high, all basically all-time high. So, like, so what do you think out of it? Your Mag 7 really don't give a crap about your 10-year fake rates. It don't, because those are cash machines. They don't rely on these 10 years much. They just moved everything into this small caps. It's just as they're just and it made it so rate sensitive. This entire index flooded with regional banks, all the smaller retailers and all the small cap companies are just, everything is in there. All the garbage companies basically. So none of them makes uh, makes a they don't make any money anyways. So now the only top 10 companies, the cash cow of IWMs, are the ones they um, are the ones that perform. So if you do the what's the ticker for this? CALF. That's the cash cow. Yeah, pasted funds. You see? Now this is this one. Wow. Cash cow is basically underperforming the IWM this year. Look at that, because it went up crazy last year. Yeah, hey there. Now it's underperforming. You see right there last year, that I'm gonna clean this one up so you can see it better. Let's see. All right, this one here. So this is a ETF. It's called CALF, CALF. Okay, it's called Cash Cows. There are 10 companies in the IWM. Sorry, 100 companies. It's a stock of only 100. So you have 2,000 stocks in it on IWM, right? Among 2,000 stocks, the 100 companies, okay, is the ETF they made. It's called CALF, CALF. It's called Cash Cows. These are the companies, they have a much stronger balance sheet. They're much better, earnings, EPS, things like this. So they relatively perform better than IWM. IWM, the rest of the 1,900 stocks, if you take those hundreds off, is the pure garbage. Okay. So those companies are the ones that goes under pressure as soon as the 10 years is gonna spike back up. Because the smaller companies has to eat because they have to borrow money. When they borrow money for their business, they borrow at a higher rate. When you borrow money for the higher rate, it shrinks your profit margin. Okay, because you got to pay more juice, more interest in return to borrow money. So they are not a strong company they because they don't have enough big market cap. On top of it, they're struggling with those higher rates. Okay, so that hurts the small businesses more than the bigger ones. The bigger will get better because they are much stronger. They have the ability to buy the smaller companies because they have enough cash flow. You know, these companies don't have enough cash flow. They're struggling because they highly depends on bank money. Bank has to lend them money for them to keep their door open. Now they have no choice to stay in business. They have to borrow cash. If they borrow cash, well, that hurts their stock. So it's always some benefits, some takes a hit. These 100 companies were outperforming here the entire ETF. It was kind of pacing the same way. Now from here, you see, is not really going up because it had a pretty big run. So you gotta Google uh, CALF Holdings, CALF, and you're going to take the list of those companies, which one trades there. So I mean, normally if we go back, I don't know if we're going to go that far. The CALF is gonna have, oh boy, I don't know what happened here. The CALF is gonna have has a better return than let's see, make this thing a little bit bigger. Bigger side by side. You see, they're pretty neck to neck. But if you go to, you see, so this CALF normally outperform the main IWM. So see, last year it had a monster move on CALF. You see the 33%. And IWM last year was only down half of it, 15. So you get a lot more alpha and return on this ETF compared to IWM ETF. IWM is only paying you 10-15%. This is paying you double. Okay. And there's only 100 companies that it tracks, but you get a bigger return. This year is not doing good because it had a pretty huge run last year, you know? So you don't expect back to back 30% returns. There's gonna be, we could expect next year to pick up again. I don't know what the stock is. There's a stock chart. So if we look at a weekly, I mean, this is the run that it had, and it's just consolidating basically right there. You see, it's in the first third of the third thing is very, very small. It's gonna hold this low, 42.14. A huge first swing down, made a new high, but it formed a double top. It's gotta make his way up. I'm only like counting waves in my head. I don't know, my brain is kind of so wired up. Like every time I look at a blank chart, I'm just gonna start picturing like where is the one and two and three, four. I'm always just been doing it for so long. I don't. It's the first thing every time I look at a blank chart. I'm always picture waves in my head. Um, yeah, monthly is one. Oh, this is a good risk. That's a second wave, second swing pullback. Well, it could definitely rebound. It has to stay above this low right there, 42 for 20. That's a double bottom. You got a huge spike from here to here. It's a good. I never traded this stock. I mean, you could buy it, own it. Let's see. You got a double bottom here. You got one. Okay. Let's see where we can. Yeah, here's our zone. Let me see. Hmm. Ah, gotta wait. It fires pretty good go signals though. Yeah, this is no go zone for now. But again, it has to settle in two. That's why the two is not in yet. Let's see. Yeah, there you go. I kind of knew it's gonna confirm this lagging quadrant. Okay, makes sense. Yeah, see that two is gonna confirm this, but if this two finds support here in this zone, right there, and then we have to look for this thing to starting to make a hook back up. That's two, and then from improving quadrant, then we just look for a swing to the upside. That's how you find trades. You put multiple odds in your favor to see if the swing lines up with your with RG, because this one is going to give you the momentum that you want, the alpha, and you want to stay away as far as you from the benchmark, from this point. So further you are, wider rotation you make, bigger the move gets in the bottom on the top. So that's how you find alpha with your trade. Um, I already looked at Tesla. Have you noticed this wave count that I just made? I know everybody had a triangle and this and that. This is a very high level Elliott wave, I can say. This is a very it's called this correction called combination. The combination is a flat zigzag to a triangle. A Y wave can be another ABC as well, or it could be a triangle. Um, I mean, you can still make a case of a triangle, wherever you want to put your that's your high. If you want to connect from here, if you do this, the price is already up there. You want to connect this high, price is already closed above there. This high, I'm talking B and D. This one, see price poked above this. So it doesn't matter where you want to land your beautiful line. So if you want to connect these highs, this one, this one, this pop right there is already went back up. So E wave was right at that 61.8, 4 versus 3, which is 23.6 to 10. This is just perfect it can get, to be honest. Clean look, right wave count, valid correction. These are the upside projections for now. I don't want to go too aggressive to see if the high is here, 414.50. I don't know what kind of a promises he has to make to sell this. In the next 10 days, we'll decide if Trump wins. That's the path, how I see it for this company. If he loses, yeah, this is another 4 years of this fourth wave. That's how I see it, to be honest. You know, this move right there, okay, is Trump win. This squeeze right there is to punish all short sellers or whatever. I don't know. It's just the only way you can own this stock and trade this stock is simply buy shares and just keep trading options. That's the only thing I've been doing. This is the ride that I've taken. I've took so far. Okay. I got in here. I remember that I bought shares in the after hours. What is that? So now this is the called post triangle thrust, meaning that you're gonna have to complete same thing. Remember the rule, 5 waves in one, like this. I don't even know if this is one, two. This is all of one for now, and then two. It's a daily chart, so it's gonna take time. So you need to complete 5 waves in one, down in two, Then you start your third, fourth, and then fifth. So that doesn't matter. But for now, you just simply run upside projections. And then from these upside projections, you just look for uh, for these prints right there. I already did all them, so it's 267. Need to still break 279. I believe yesterday high was 269.19. Look at that cute print is that. So 269.19, it needs to break 271. How better it can get. Okay. And we'll see what happens next week. It needs to break this. Okay. To open the upside. 271 breaks. I mean, I think 300 is going to come pretty quick. It's 299. Then you have 323. Then you have 359. Then you have 401, 408, 414, 497. How are we going to get there? I don't know that. You just take a snapshot, save this thing, and these are your prints to the upside. Don't ask me 10,000 questions. Where we at? Are we going to better pullback and this and this and this? No. You want to play the upside? That's your upside right there. And I will guarantee you it's going to hit to the penny, but I don't know how long it's going to take. How long it's going to take to get there. Okay, it's the same thing. You run your projections to the upside. It's the same thing. That's what I just showed you here on uh, on this. I don't sit here and label anything on a bigger time frame. It's a complete wastage of time. There is not enough subdivisions here, anyways, for you to count small. I don't know how I did it here, but it's not enough to put the price for to put a small degree wave count. I'll take this side, what we have here, this portion right there, and I'll just bring them down here to this. So then I'll just run them from here. But on this one, this is what it is. I don't even know where the 1 or 2 is. It's just a monster gap that we just had right from the start. So if this is a post triangle thrust, it's gonna get one final push to the upside, and whatever the thing is gonna it's gonna go up. It's gonna take a long time to complete, and then from there it's gonna come right back down to 200 at one point again. I don't know when, but it's gonna be the future. But it has a lot of work to do. It's nothing. Because every time when you get a post triangle thrust to the upside, you just your minimum downside always going to be this, your prior E wave. It's the same thing I told you on Meta. I'm sorry, on the diagonals. Remember how diagonals work? Here, get rid of this. This was the upside zone, is where you can have a completed fifth wave. There from here, you have price to come back down. Look, wave 4 and wave 2. Look at the low here. Let's open up again, a little messy. Look at this. You know how many years I've been trading diagonals? It's all with the price is gonna come all, I don't know if this is whatever it is. The price is gonna come all the way back down, either to a wave 2, sorry, a wave 4 or wave 2. Same thing happens with the leading diagonal, same thing happens with the ending diagonal. There's gonna be a minimum downside. but they don't. But that doesn't happen that often. I mean, spot diagonals, so they take forever to to complete, and then to make a case for a diagonal is always a little tricky. But you play 6.87 moves, 602 down to 562. So that's what, 60, 40, 40, 42, 44 points, 44-point move. So they're pretty easy. I mean, I can show you hundreds of charts like this. If you can show me a diagonal, a valid one, and then I could that we could make a case for that. So this is done. So I don't. It looks like a. I know Meta earnings are coming up. Mahanami looks. It's a very strong stock this year. Very very strong. If if earnings get rid of this, see this way I can pick tops on stocks. It's still it's not that bad. You see, like you can just build a zone like this. You see right there. Now you have 200, 161, 261.8, and 61. You know how strong these fibs are when they basically when they all stack together. When you have 200, 261.8 within 161.8 and 61.8, all these golden ratio, they come that tight into the certain zone they call cluster of fib resistance. That cluster of fib resistance, you don't break these fibs that easily unless you take set of setback, you know? So this kind of a clustering, you don't have them here, Like if I'm not gonna do it now. I run all these fibs from different swings is to see if we can make this certain zone a thick wall. It just doesn't give me that. That's why this is very difficult to pick the market top. The market top, the price, okay, will top out a lot of time when you have a lot of fib zones that all lines up here at the same time from from several of your previous waves. It all ends in one zone. Is this where you will expect the price to start to take a move, take a bit of a pause. So I'm taking a small counter trend moves, you know. I mean, if you want to like position yourself for like a 4 or 5% move, that's different, But if you view a market, that's how I see things, I look at things like 4 or 5%. What will be the 5% move from the market? You know, I take I take a quarter. Okay. So if I see like, okay, a quarter is have a higher bar, okay, it means that the quarter has a pretty good chance that the quarter will be okay for the next 3 months. So that's one point, right? So from the one quarter, you go down to a weekly side. The weekly say like, okay, I can see the weekly swings are up, right? So now the quarter has how many? 12 weeks, right? To make one full quarter. So if I got confirmation on a quarterly bar that already has a higher bar, so it means it has a pretty good chance that is going to make a little bit more room to the upside because it's taken out the last quarter high. This is where I see weekly swings are up, daily swings are up, signals are in there. So I can stay long, you know? So that is always my approach to think ahead to see like how I can adjust to see what to make out of the one full quarter. But now, if your attention is to sit and or where I can catch a next 40-point drop, that's different way of looking at things or approaching the market. When you when you start looking at prices on a bigger time frame and then you bring them yourself down into a small time frame, it's going to change everything the way you look at the market. I promise you that. you know to looking at things at a smaller time frame to draw a bigger picture is very, very difficult, because we know, and I know, that once you have a higher bar, it has a very low probability that it could reverse, meaning that it could turn into an outside bar. you know Most likely it's just going to close positive or slight, or most likely flat, because it already making a new high. So that's what you need for an uptrend, is to make new highs, meaning to take out the last high is to make for price to move higher. Then you run your projections to see how far the price can expect it to be rise, can move up. Same thing to the downside. You're taking out a low, then you're just making lower low. From the lower low, and you just keep running your projection to the downside to see where you can find a potential support. That's all it is. It's support, support and resistance. You have a ceiling, you have a floor. I mean, you can do an easy way, or you can just do a little more fancy way. You can do, but yeah, Meta is I mean, this the where if Meta earning comes up strong, I mean, next leg up we can do from here is that, again, 100% at least measured move of 683, or that would be from this low right there. And that would be the upside from here, because we have huge run here. That's your down. That's going to be your, or it just, if we have to open this second wave, it was barely close to that. So that's going to be a downside window for this second wave to come back down against this. Now, this had this. Now, if so, your earnings are tricky. Now, if the price does come back down, and now this side has to stay smaller than this, you know, that's your higher degree. That's your smaller degree. You want to go up in a smaller degree to complete five within this three, the blue three. Yeah, so this three, this second wave, you gotta make sure stays less smaller than this one. If this thing is bigger, we're gonna have a problem. We gotta adjust this thing. If this gets bigger, it's managed to stay above this low, but then this fourth right there, where that triangle ended, it's gonna turn into a diagonal. It's the only way you can always think of. So we'll turn like this. You got one, two, three, overlap with four with 542 right there. So you got one, two, three, four, five. Because wave five, whatever this one is, you cannot put it here, because this is only a three-way move. Wave five cannot be a three-way move. Anyways, it's a motive wave. You need five waves to complete one higher degree of fifth wave. I like meta. I mean, if the weakness comes into a play somewhere around here, so you just gotta have to slide this thing down here. That's all, which is gonna take several weeks for this to kind of dance around here, then find its way back up. If not, this is all of two, right near this 38.2. We just had against this. Already to rep. Need to take out this high, 602. So whoever's going to be bullish on Meta are looking to play 602. And if you are bearish on Meta, you're looking at 550 to the downside. That's the only two plays that you're going to be possibly. I don't know which side is going to break. I mean, I could try to make a diagonal to see if, but I did a pretty, I didn't post it. I did a diagonal on ServiceNow because it paid me so good. I only took one. That was a that was a nice payout on that stock on earnings. I did a what's that over 100.1 was like $4. That I paid like $3. So 400 and 300 took one each only. Made like $1,000. Like perfect. Um yeah, we'll see. But when they're gonna report, I'll run some yeah, when you have a double diagonal, I'm just gonna tell you while you're listening here. When you have a diagonal like this, yeah, you wanna either get here or get here to get paid. And this one right there is gonna have, I mean, the way I adjust diagonals, the way they call this is called double diagonals. You have two of them, right? So the price is either here, can either get here, or if it pushes down, it stays here. So your payout on diagonals is in this two tenths. So either you get here or either get here. You're gonna get paid. But if you stays here in the middle, it's not gonna you're gonna lose some money. The way I adjust these ones, but if the stock doesn't move, you're not gonna have any kind of a big loss because I'm gonna cap my loss to a very minimal dollar amount. Okay, because I don't know because I'm playing earnings. DXEM made a big move to the downside. I thought the sucker was gonna stay here, but it closed all the way in between here. So that's why I lost like I don't know 60, 70 bucks. Because I just that's how I make them is to see if price managed to stay here, it's not gonna hurt me much. It's like a same thing. Like I don't know if you ever trade the straddle. You know, the straddle is it's the same way, same concept. It has a very straddle has uh, both ways payouts, and then if you manage to stay in between, if the stock doesn't move, you're gonna get crushed. The straddles, strangles, they have a very high negative theta because you're playing both sides. Either the price to pop, you're gonna get paid, or if it tanks, you get paid. So people mostly trading strangles. Here, I'll show it to you. So let's say here's coin. So you gotta find a high beta stock. Let's say they have earnings coming up here on the 6th. So you could do slightly out of the money, buy one, buy a straddle, or whatever. Same thing. So it costs you $2,000. What are these? Um, anyways. So it costs you $2,000. Now you analyze this trade. Here's your trade right there. You see, you're sitting right there. Look, your negative theta 164. You will be higher negative theta because if you're going to be next day closer to expiration. Right now, you have quite a bit of time. I'm just giving you the example. Okay. So Most of these traders, they're looking to play these strangles, the whatever straddle, is to play both sides. See, like if the stock uh, pushes down, you make money, and if it pops, you make money. So they're looking to win on either side, but the stock has to move. Okay, it's the strike that you're buying plus the debit that you're paying is the where the price needs to pass to get to reward you. Okay, so your break even point is this, you know, right there. So you basically take the strike price that you're buying and selling, okay, because you see you're buying a call and you're selling a put for 210. 210 plus the debit that you're paying is your breakout point on both sides. If the price managed to closes stays in between this zone, you're gonna lose all your money. Okay, that's how straddle works. Strike plus the debit that you're paying, any upside, whatever the strike that you pick. Okay, obviously that if you're gonna pick anything close to the money, is always gonna pay more. If you're gonna go slightly out of the money, you're gonna pay a little bit less, but then you need a much bigger move. Let's say you want to do a $5 straddle. Go to do this. Go straddle 2460. It's showing more because it has 6 days, so it's calculating much higher. Once you do the next day, like like next day earning move or something, or 2 days before, is gonna have less premium that time because right now it's pricing in 6 days worth of premium as of now. So I'm just giving you an example. So regardless, whatever the strike is, so whatever you buy or sell your strike, you add the debit that you're paying for it. That was going to be your breakage point. From there, any upside from there, you make money. Now, anything from the downside, you make money on both sides. So that's how straddle works. So the example that I was showing, I'm gonna make those diagonals, gotta play around with those strikes. So the diagonals that I was showing you was you notice like something like this. So it gives you an edge on earnings, okay? To Well, first of all, nobody knows how the stock will move on earnings, right? It's a wild guess. It's gambling. Okay. So if you like this is a coin, so you have 200. So let's say you make 100 to 200, and then from here you can make another 200 to 300. So you can do this. So now you have quite a bit of room on both sides, right? And what the advantage of trading diagonals is, like, if the price moves here, and if it manages to close, you make money. And if the price rip through from here, yeah, of course you're going to lose money then. Same thing here to the downside as well. But it kind of, when you look at a stock that it has what the expected move is and things like this. So you can structure it that way, but you can't just randomly pick strike prices like this and thinking like, okay, I'm gonna get, where I'm gonna get lucky. But it kind of gives you a cushion. It kind of gives you a room on both sides. If the stock falls, you can make money. If the stock pops, you can make money. It's very similar to straddle, but the advantage of this one is that it doesn't hit you really hard with negative theta like straddle and a strangle does. The straddles has a very, very high theta, meaning if first they're pricey, okay, diagonals are much cheaper, and 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 if the price manages, it doesn't really move much, meaning like if it kind of stays in between in this zone, so you have to kind of like select your strike, like you don't get hurt that bad, you know, because it has a lot less theta. And if when the implied volatility is going to crush, it's just not going to hurt those premiums that hard. So you have the loss is very small on this one, but you just kind of have a cushion on both sides to see that where you could make some money. And the diagonals that I trade, they're like 25-30 cents per contract. If you notice that, I make them that way. I'm not paying, you know, $5-6 for a stupid diagonal. Yeah, 30-40 cents I pay for them. I make them that way. So it's 30 cents. I mean, you playing one contest costs you $30. So I try to do like at least five of them, 5 or 10. So 10 for 30 is $300, right? So if you, I mean, again, this is the money that you're willing to lose. You can do $200, and each side, $200. I mean, it can pay you pretty big return if the price the close anywhere in between this zone and this tent right there. That's where you have your payout. This, if you're gonna get out, you lose. If you set in the center, you lose. So that's your. I like this kind of risk reward. You have a much limited loss in case if the stock goes opens flat and doesn't really move much. But if the stock does make a move, either to the upside or to the downside, you get paid. So similar to the straddle, but again, the only edge you have is a lot less theta. That's all. That's the concept of a diagonal. But you're not gonna sit and start drawing your diagonals because you don't even know what the levels. You have to know your levels, to see which strike price to pick to to make the. It's like a tent basically. You just basically sitting in a tent. You don't want to come out. You sit inside the tent, you make money. As soon as you're gonna come out of the tent right there, yeah, you just okay.
Mo, so I had promised that I would learn from you on the end phase trade that we did. And I had made some notes on Slack about the prices and put some screenshots to decide what the best strategy would have been.
What did we do on this one?
We did a double diagonal, 79.80.
Oh, the thing is gone now. What is see this? How do you oh boy.
Can you hear me, Mo?
Yeah, yeah, I
Yeah,
can
yeah,
hear
I can
you. I'm
hear you.
trying
I'm
to.
trying.
Why there's so much echo?
Uh, it's gone. It was on my side. It's gone now.
No, I was trying to think like the trade that I did. How do you analyze the old trade? I forgot. There's a history of the old trades, right? Can
I don't know. Is it called you look back or something? You look back and
No, DOS doesn't have the look back feature. It has the tab where it keeps
Is it called on demand up there? The on demand on the right, top right?
No, no, on
On,
demand is different. The trade that you already did, you could just expect to see how because the expiration is gone. So you cannot analyze the what is this one? I don't know. This trade is I have to look. I will let you know.
I have some screenshots on Slack on from Tuesday. Are you able to pull
Okay.
those? I had put prices there.
So what are you
My question was that it was about trading before earnings. It was in the 90s. Okay. It was about 90, 92 before the earning came. Um, it was around that red line of yours. The pricing was close to the red line.
okay?
And I was expecting that okay, it's a very strong possibility because of my research on it that it would drop 10 points or more. But the expected, when you tell us, expected move, look at the expected move in TOS, it was already 10 points. So I asked you, what is the best way to play this trade? And you had initially said butterfly, but then you finally came out with a diagonal.
Yeah,
You
I
said
did.
butterfly is the better way, and then second is diagonal, and then we did a double diagonal. And I'm wondering whether I would have been better off just selling a buying a straight vertical put because I had such a strong conviction that it would go to the downside, or should I have gone with a butterfly, or was the double diagonal the best strategy?
Yeah, you could do that. I mean, again, if you are sure about, I mean, again,
No,
earnings,
earnings are always a gamble. I understand.
correct. If
If
you
you want to
have a
smooth,
gut feeling, look,
yeah,
sometimes you have to go with your if you have a high conviction thinking like, I have a gut feeling that this stock is gonna tank, right?
yeah,
If you have that feeling, sometimes you do get them into an earnings. Like there's going to be a certain company that you come across, you say like, hey, you know what? I have a pretty good strong feeling that the stock is going to make a big move to the upside. You just simply just buy calls, okay? And if you says like, well, I just want, or you can just make a spread. But the point is like when you have a stock like this, because you see the volatility all came off. When you have IV, that implied volatility is when you're just gonna go up like 250 to close to 300. Okay. The only way you can be able for buying premiums with 250 and 300 implied volatility is ridiculous. Okay.
it was
It's
100%. It was about 91 or 100% that day.
it's very high,
Yeah.
very high. Okay. I mean, this kind of a premium that if you have implied volatility, which is 250 and 300, and 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 you just bought a call, and if the stock can move like, let's say, 4 points in your favor the next day, your payout is not going to be nothing. Okay. Because when that volatility is going to crush, then at the open, those calls are almost toast. you know so it never makes sense to pay for such a high volatility. You need a monster move, okay, in order to get paid. If you pay this much for volatility up front, that's going to come off right at the bell. Okay, so always consider a next week. If you wanted to play a direct, it will give you at least bit of a breathing room in and on the implied volatility. You can still play the expected move, and you can just get paid. It really doesn't matter. Let's say you have, let's say, the next day earnings, right? It all depends how much delta that you're gonna carry into an earnings. So if you says like, okay, I want to take a 30 delta shot, And if you're going to take a 30 delta shot with a 300% implied volatility, this thing is going to be toast at the open. Okay. You need to move like almost up till here in order to get paid for this premium. They're not going to move much because the volatility is going to hurt, that's going to come off. So if you, so the best ways to do is to go to a next week. Okay. So you say like, well, I wanted to pay $1, but I'm paying 300% IV, but you could go a week out for the same 30 delta. Okay. But it's going to cost you $100 more. Okay. In this case from here, you could just simply say like, okay, if I want to do a 30 here, I can just make a spread here. For the same $100 that you're willing to pay for the same week with 300, you can make a same dollar 20 spread here for the next week.
No, I get that. That would be a vertical, right? That would be a vertical spread.
That's a vertical spread. Yeah, you buy 92 and sell 98. So you can just adjust this one. You say like, okay, I can do 9,200. It'll go up $1.36. So you can play around with your strike price. You can make, here's your $10 move.
I guess my question is how to decide better the vertical is the better option, the butterfly is the better option, or the diagonal is the better option. How to decide between the three?
The best one is butterfly, to be honest, but butterfly is a little bit tricky. Okay. The reason why it's been is because you wanted to go up, but you want to make sure the stock can just take a pause. Okay. That's a butterfly is like, okay, let's say this thing is going to have an earnings coming up at 83. So the stock is at 83, right? So which is right there. Now let's say we say like, okay, the expected move is 10 points. So it would be what, 93? So you got
Or 73 or 73. Yeah.
73. So you have 93. So you take the current price, take 93, go to analyze, go to 93, right click, buy butterfly. Like this. So you have a $10. Now you make this one to 82. Then you have from 83. So 83, 93 is 10 points.
Mhm.
And then from here, you can do 100. Now you have $2.46 for a $1 debit. So when you analyze this one, there's gonna be a butterfly like this. So all you have to now, you have a $10 widespread between the first strike and the middle strike. And this is where the most payout, the butterfly strategy is that you wanted to keep $83 strike in the money. Okay. And you want to let the $100 and a $93 expire worthless. That's where you're going to hit your jackpot. You want to kill the premium on these three options with time. So when volatility is on the rise, okay, you're selling two against you bought two. Sorry, you bought two and you're selling two against it. So you're long 83 and you're long 100, but you sold twice in the middle at 93. That's what they call the body of the butterfly, which is right there. So now you're risking $246. So now you want, here you are on this line. And now if the stock pops, goes up to 93, so you paid 246 with 350. So now if you take the next day butterfly, because it has the very short expiration, so then the volatility is going to come off, which is already sitting at 300% IV. So every time when the volatility drops, it's going to hurt this center strike really hard. Okay? Because you already short those calls. So it's going to hurt this one. So this one is going to get hurt. So the premium on this 93 calls right there, this one. Okay? Which one are you selling? 93. Which is the body of the butterfly. This 93 is the one is going to get hurt the most because you short those calls. Okay? So you basically what you're trying to do, then you need to do is you're gonna have 83 is gonna go in the money, then 93 and that 100 with time. As long as this price will close anywhere in between here, okay, is all your payout right there. So now this one has a potential to make, now if you take into the body of the butterfly, $746 right there in the blue window. So you risk 246 to make, but you don't know where the price is going to stop, first of all. Okay, that's the thing. So now because each day has to pass by, you have to collect the time decay. You see? And now it doesn't matter if the price can go up, you still, and as long as you stay in between these two zones, it's all profit right there. So this trade right there, you don't have to even close it. You just let it expire. You don't get assigned on these butterflies. Remember that. Okay? Because you're long two and you're short two. The short one is going to balance out your long ones. So you don't need to be I have to close my butterfly. No, just let it expire. Who cares? I've I mean how many years I've let butterfly expired? Nothing happens. So they're gonna balance each other out anyways when they're gonna close it. So let them eat the commission as well. Because if you let the thing expire in the money, if it's gonna settle over the weekend, they don't charge you commission either. So you now imagine if you do this all year long, how much money do you can save?
You can do a butterfly even if there is like 2 days for your earnings and expiration. Like if the um, earnings were on Tuesday evening, and expiry would have been Friday. So do the same Friday expiry for
Yeah,
butterfly.
yeah.
Okay.
I wouldn't, I mean, look,
Mhm.
I if you're learning, this is a very advanced strategy. You're risking real money, okay? I mean, be just if you, I mean, I don't know which stock you like, and I mean, if you wanted to, if you want to play on your own, I will I will give you levels. You just gotta have to. I'll give you this, and I'll I'll show you the where the price has to break to get to this, where the price has to take the green one off out to get to the other one. So I'll give you both sides. So you just have to make a butterfly on your own, and though I'm not gonna be, making those for anyone. Just just to if you need help with, um, you can try like one contract, okay, um, just to see how it works. Because if something new, like if there's a new strategy that you never heard of them before or you've never traded that before, you don't practice with real money. Okay, you practice with, if you want to trade one contract, fine, you can do that. I mean, you're just try to do some paper trade just to kind of get used to it, to see what's the concept, what's the logic is behind this, and then you kind of improve over time to you will have a much better idea how to analyze, how to look for a trade.
Yeah. Thank you. Thank you
Um,
very much. It's helpful.
I'm doing diagonals for now, a little by little, just to you guys kind of familiar with like what the concept is, what to look for, how many couple, like Netflix, you see how it went up and then it came back down, it was worth over $1,000. Netflix, I even took a snapshot at it. I mean, Diagonals has a lot of potential, a lot of power. But the point is like if the price comes, hit one of these and hold, and it can just lingers around here, is that's where the beauty is,
Yeah, I think
you know?
somebody asked you the question, diagonal. The only concern that people had, I saw from the chat, and I myself had it. I took the trade. I was okay on this diagonal trade. But if the stock tanks more than like two or three standard deviation and
Oh, you're gonna let her.
falls way below, then you are stuck because you have that sold call, you have the
Oh
sold,
yeah,
you have the sold put. So
yep.
how do you manage that risk, in a diagonal? Because
You're
you
gonna
start,
take you're gonna
huh?
take a lot. If you have enough time,
Yeah,
then you can close the other one and hope for the price to recover. Like it, but most likely you're gonna have a loss.
most like, and so is the loss unlimited is my only question. Is there a defined loss in a
It's
diagonal
or
where the
di
stock just
it's a little
stock
bit
completely
more.
tanks?
It's a little bit more than what you pay.
So you will lose money. Okay.
Correct, correct. But you again, I don't let things goes max losses. You don't. I don't think you ever see me taking massive
No, no, I
losses.
don't. I don't. But I think people were a little
Then
concerned.
you
What
will.
if it dropped below $72? I think that was the question people,
Mm, yeah,
yeah.
if it can, I mean, I'm like, where did I center this? What the strike? Hang on.
79 and 80. You sold the 79s and we were long. No, we sold the
Hang
80s
on.
and
Let's
we were short. We were long the 79s.
ENPH. Okay. See, it's not gonna let me. It's gonna give me a November full strike, but it's not gonna give me the 25th October. I think it has this. Oh, here we go. I think, yeah. Here's a history of this. She analyzed this one. I remember I did five of each. She's not giving you a print yet. You see the strike went up. Okay, so this expired because the stock strike. See, it expired at $22 right there. See, I made two of them because then the volatility came off. See, it says $22. I made like, I don't know, $167 or something. I think that's what I closed them at. Um, when you close a diagonal, you can just you don't have to when you place this trade, you place trade with two separate orders, okay? Because you doing it both sides. This is one order, that's the second order. And when you close in a trade, you simply select all four of them in one shot. You select this one, select this one, select this one, and select this one, and then you right click. Okay, so let's say if I will flip this thing, create opposite order. See, but it's not going to give me the bid because the thing expired. So the point is like you select this, all four of them, right click, and then confirm, and then you just select the credit because you pay debit. You have to close the thing with a credit, and then you can just close all in one shot. Because every time when you're gonna try to close one each individual strike, you pay commission per transaction. So do all in one shot.
What is the gray zone that you're showing? This gray zone in the middle? What is this?
It's a one standard deviation move up and down.
Okay.
So this one is at 22. So see, like if it could go up, we're just looking at the one because the one strike already expired. I mean, the payout on this one is that the price backs off here, and but can took a tank like here. So I mean, it's didn't really was hoping for, I think I centered this thing at 80. Yeah, 80 right there. I sold five of them at 80. So we're right there. 80 strike. Because I had this. So like, okay, I'll center this one at 80, one up paid on the top and see if it can, and then it came back down, but this stock is just ridiculous. This stock is gonna worth zero one day.
You might be right on that.
No, this company, the thing is, this company is burning cash. You have no idea. They have their board has authorized so much cash buyback, and they've been doing this thing for all year. Company cannot, they don't have enough demand, then they cannot even do enough business, whatever. And and look at their earnings. And why, if the company growth is, if you don't have enough demand, if the company is not growing, or that you don't have enough business, why are you burning cash? Because tomorrow it can help you. Because just go through the transition. So like, okay, shit, things are tough. Cut your cost, you know, bite the bullet, let some people go, reduce your payroll expenses, things like this, is to see where you can make some adjustments to your balance sheet. But the cash that you have in hand, you buying those shares back, and on a struggling business. Does it really even make sense? I don't know. Like, just some companies boards are, I don't know, like, how are they voting for this thing? This, I don't understand, because they're desperate, because their own money is stuck in their shares when they bought them at 200, and now they cannot see that thing that the price is at 85, and now they say like, oh yeah, we're going to do a massive buyback, we can push our stock up so we can get out, because that's what it is. Oh well, you need to focus more on your stupid business to grow, not to sitting on your cash and thinking like, yeah, I can just start buying back my shares. You're not Apple, you're not Microsoft, that you're going to turn your stock like them, like them, you know. Smaller, it just, it's the same thing like Boeing did. Why Boeing struggling right now with cash? Do you know the history of Boeing? Boeing had a CEO 10 years ago, that asshole bought that many stock, that aggressive, every quarter. Okay. This guy was announcing cash buyback, cash buyback. He retired, took all his money, and now Boeing is to the stage they have no cash. Now they have to sell bonds to raise cash because of the strikes and everything else. They don't want to take the loan because they have to, they're going to put restrictions on them. Boeing didn't took a loan when the COVID happened. All the other travel companies did took out a loan. All the cruise lines, all the booking.com, all the Carnival and all that. All of these companies have taken out government loans. All these companies, government owns them. They have some part of um, shares in that company. That's why Boeing doesn't want to take the money when the COVID happened, because Boeing got hit hard as well because of travel demand. They instead keep borrowing because, well, you were desperate, you need money, you're gonna borrow money, they're gonna need some sort of surety from you. Like, okay, fine, I'm gonna give me 5 or 10% of your business. I'll give you cash. When you are net cash, when you're negative cash flow in your business, you will do everything just because you want to survive, you want to eat, you have people to pay, and payroll and all that kind of a stuff, because you're desperate for cash. So if you're desperate for a cash, so the other person who's looking at your financials, he's like, okay, I will lend you the money. Okay, well, I need 5% of your business. Would you ready to give up a ownership to somebody for 5%? That's what it is. I mean, it's just, again, the other person needs some sort of a surety, thinking the same way as well. If it's a struggling business, he cannot keep his door open. How am I going to get my money back? Yes, it's a risk, right? So you have to look at this way, that everything in life is risk. You're not going to just hand somebody money because I really like you. I want you to stay in business and do well. Well, my business is not going well. I'm burning cash. I need help. So you go to the bank, and bank is going to ask you 10,000 papers. Show me the returns, show me your tax files, things like this before I'm going to, we need some sort of a surety from you to lend you the money. So Boeing is in the same way as well, into that spot. They don't want to borrow money from government. because they're going to ask shares in return. So they will become a part owner because it's going to have some restrictions on them. Nobody's going to hand you any money, you know? So same thing with these rich people that you like. Rich people, how they are rich? They are on a company payroll, right? And they wanted to go and buy something. So what did they do? They go to the bank and they borrow money. So they on a payroll, they get a regular check like everybody else does. They got their yearly bonus or quarterly bonus, depends how their pay structure is structured. And if they wanted this, they're just like a regular employee. So now if they want to go buy something, I want to go buy a jet plane, okay, cost $20 million. So they just go to the bank. They're like, okay, I want to borrow $20 million. So so the bank asks as a collateral. They're like, okay, I will give you 20 million. What you have, which is worth $20 million. I have shares. I'm a, you know, I have this much percentage in a company and I have this much shares. So he could use those shares, like if he needs cash, he can sell those shares. As soon as he's going to sell it, he's going to have the capital gain tax, which he doesn't want to pay because he wants to avoid the tax. I want to pull the $20 million worth. I want to sell $20 million worth of shares. I want to pay a capital gain tax on $20 million of the money of the shares that I own, that I sold. So when you take out a loan from a bank, that's a debt, not the income. So you cannot claim a debt as an income, right? So you take that loan, you buy whatever you want to buy, you have it, you have your beautiful plane, and you borrowed money. You have no tax. So your payroll comes in, and then you get to a certain point, what you've been doing all year, and then you come out to a certain point that you're going to start selling some of those shares. That's when you see Jeff Bezos selling some shares, Warren Buffett selling some, like Bill Gates are selling some shares, Dell owners are selling. Like these guys will sell shares per a certain time is because their payments are due. So they're going to sell those shares now is to pay back their loan. It's just the cycle. That's it. So you avoid those taxes as much as you can. That's how you play the game. Rich, all these. You gotta have to have something in return to put them as a collateral, and you keep borrowing money. You get whatever you want in your life, and you don't have to pay a dime back. Or give them as a collateral. It's like, okay, here, I will assign this much shares to you in case if I get defaulted or then I don't pay you on, you can sell my shares.
That's
Companies will love to buy shares on a healthy company because they know those shares will appreciate over time anyways. Who doesn't want Apple shares as a gift? I would take it in a heartbeat.
That's why rich people also like inflation because the value of their assets, which is collateral, goes up so they can borrow even more.
Correct. It's all about borrowing money. You remember the guy, what's his name? The guy who was playing China. What's his hedge fund guy? A couple weeks ago was like buy
Bill
China. Huh?
Ackman or
No, what's his name? The other guy is a pretty famous hedge fund. He's
Pershing Square or something. You know, Bill Ackman. I thought it was Ackman.
no, not
No,
the
no, no,
Ackman.
it's a Tipper.
Tapper.
Oh, David
Yeah.
Tepper. David Tepper.
Oh, that guy. Oh, that guy is he's good. Yeah, he's that guy plays a hardcore gambler, basically. He's a very good track record. He owns a football company as well. I don't know which one is that. The Jets. So I gotta Google it.
He's
And
now all in China.
he's heavy in China. He says what he does. He borrow money, okay, buy stock, and just that's all he does. He says like China is literally given free money. It's like give me as much as you want so I can buy it.
But Mo, didn't you say that
It's
if
all about
If
lending.
Trump wins,
You have to
you said that
understand it's
if
all.
Trump wins, sorry, you said that if Trump wins, then China will devalue yen. Does that mean that
I don't know.
all the Chinese ADRs will get smoked? Because we are buying in dollars, right? We are buying in Baba, Baidu, all these companies, Chinese companies, Americans are buying in ADR, right?
Currency is a totally different. Well, currency is basically everything because we have to use them on a daily basis.
Yeah, I was just
But
shocked with your comment.
we
You said that
don't.
if they will devalue.
I don't know if somebody's approach, whoever is thinking this way, but I'm sure that if Trump is gonna go after it, because here's the thing, okay? Tariffs are basically, he thinks that putting tariffs on countries will benefit the country big time, but you're basically using that threat and power to punish consumers. Because you have to look at this way that you are sitting in Japan. I'm a buyer in the United States. Okay. I'm says like, okay, I need 50 pallets from you of XYZ product. Is gonna be cost is $20,000. Okay. Just giving you an example of 20 pallets, it cost me 20 grand. Okay. So I have an account with you says like, okay, you are one who's going to make me 50 pallets of 20 grand. So I have to adjust. So if you have a price for your product to say like, okay, we both agreed at 20,000 landed cost to United States, okay, for 20 grand. So I pay you 20, you make the product, you put them in a container and you ship them over here to United States. And I wired you $20,000. Now you have it. So you got your 20, now you off the hook. The product comes here. Well, now I have buyers that want to sell that thing for 21 or 22, or whatever the price I have with my buyers. So for the 20,000, if I sell all those pounds for 22, okay, that's what my landed cost, net cost was. So I made 2 grand, right? So that's the simple transaction that you're doing from one to another. So he what he's trying to do or what he wants to do is to put tariffs on it. So his tariffs are like, okay, I'm a buyer, product comes here, he hits them at the duty at the port for 20,000. Now the 20,000 you're gonna hit 20% or 30% tariff on it, tax on it. So what is gonna happen? Well, I paid you 20. Now on top of it, I gotta pay tax at the port because I have to release those containers off. So my cost is gonna reduce, right? Because I was agreed on $20,000 with you. You say like, okay, you send me 20,000, I'm gonna send you 50 pallets. Now this guy says like, okay, anything is gonna come here, okay. All of a sudden now I gotta pay tax on it. Okay, so my landed cost from 20,000 went up to 21,000. So my profit margin with my buyer went from 22 down to 1,000 now. So I was making 2,000 before, now I'm making $1,000 because I got to pay $1,000 tariff at the port. So my cost went up, right? So how do you offset that thing? So because I want to stay at 2, you got your 20, you off the hook. I have to deal with the port and now I have to deal with my buyer. Now you have to go back to your buyer, renegotiate the contract, because most of these big companies, you have to sign contracts. You lock your price for X amount of years. Now you can, it doesn't matter, your cost goes up or down. You sign the contract. If you don't have the signed contract, then how do you offset the cost? You're going to raise prices on your product. That's how consumer pays more. The consumer pay is going to be more. You're going to, so instead of the buyer who's going to be paying you 22, he will pay you 22. And now what he's going to do, he has to eat as well. He's going to raise prices. The price is going to go up. Who's going to pay for it? You and me at the store. They have a cost as well, right? So it's all about supply demand. So what he thinks that put tariffs on him, you're gonna collect the money at the port by bringing everything here, but at the same time, well, people is gonna either find cheaper product and go somewhere else, okay, because they have to reduce their cost. It's like, okay, I don't want to go to Japan because it's costing me 20. They will say like, I'll go to Thailand. I'll get the same product. It's gonna cost me 15 grand. You see, that's how the shipping will start moving. There's like, okay, well, if you locked up with me with a contract, that's a different thing, because a lot of companies, they don't want to sign contracts. A lot of company wants you to sign contract because they want to lock you in, because they don't know what the future holds. At least they got their exact price, what they want to sell their product. Now it's like, okay, well, 20 is not working out for me. It's only going to leave me with $1,000 profit. I'm going to go to Thailand now. I'm going to get the same product, build them in Thailand. Now it's going to cost me $5,000 less. Now I have a $5,000 window. You see? So cheaper the product is into a cheaper countries, more you can reduce your cost. The same thing, everything coming from China. Everything from China is cheap, right? So they're working over there. There's no overtime in China. You can work 12 hours. That's it. You're going to work 12 hours. Here you work more than 8 hours. You're going to pay overtime. So this is his thing is, I think tariffs are excellent way to pay off debt and to punish all the countries and this and yeah, I don't know. It's just, we had them. He still have tariffs. I mean, there are, but at the same time, what he's trying to do is he's thinking like the other countries take advantage of our country. Okay, at one point, it does make sense, right? Because if you have General Motor car, you want to go to Japan, they're going to tax your ass like almost 100% of the duty port. You can't sell that car there. Okay. So it's the same thing when you go to China or you go to all the other countries. So you can go so they will tax the hell out of you at the port for you cannot enter their market. But when it comes to United States, okay, we have Toyotas here coming from Japan. We have Lexus here coming from Japan. That's okay. So we're bringing a massive amount of cars coming from China to United States market, okay, for their country, their economy to boom. But but when you try to sell a car there, they will tax 100% of the port. You see, that's not fair. So his thinking is to go after countries who are exporters, Japan, China, because their economy based on export, right? Is to collect money from them. But there is always an offset for it. You can't be a win-win from just to punish one side and thinking that I'm going to benefit everything from it. No, you don't. Because there are suppliers, there are buyers, and they're going to have to renegotiate their contract. They have to readjust their pricing and stuff just to offset the tariffs that he's going to put them on these ports. Has to factor somewhere, because it cannot just disappear in a thin air. You have one product that is coming to you for 4 years under Biden administration. And then all of a sudden he gets in, he pushed tariffs on it. Now the next day, what do you think is going to shake the market? Consumer price is going to start going up. Okay. So now all these buyers and seller has to get on their phone and try to renegotiate. Like, hey, I cannot buy stuff from because I don't have enough left for margin left for me to buy stuff product from you anymore. I know your cost is your cost that I've been paying for the last 3 4 years. Now my cost is going up. So how I'm gonna make up my difference? So that shrinks what? Your profit margin. So when these big corporations, when their containers are coming here, if you have a public trade company and if you have import export business going, what do you think is going to happen? It's going to shrink their profit margin because you're paying more tariffs at the port. So how do you reduce cost? You reduce your payroll expenses. Let people fire you. You fire people at the company now. Well, I cannot afford. You have to rebalance. You have to let some people go, especially the ones who are the top earners. It's gonna you can't win both sides. It's the same thing here in option market. You can't there is no strategy in the option market that is almost risk free. There's risk on every trade, regardless, but it's a matter of you just be one single move, like everybody else doing it every single day, as fast as sucker can move up to the upside. I make my money, I run. And if this thing goes against me, I lose money, then I'm gonna cry. Why is not going now? Why I'm wrong? I shouldn't be in this trade. I should have cut it a long time ago. It's all 10,000 doubts comes in your head all the time. It's we're all humans. We have emotions. It's totally normal. Should I cut it here? Should I hold it? Then the next day it comes down even more. We're all been through it. It comes up till here. And then you hope and pray, and I hope I can just at least break even, get out of this stupid position. And then you come back down to break even position. Here you cut the loss. The next day the trade is here. How many times that happens? This is a life that we live in every single day. This is where the decisions we have to make. Where to cut. This is trading. Nobody knows in the world where the price will stop. But the different strategies, okay, that they have in the option market is there for a reason. If option market would be all about single calls, there wouldn't be any verticals, wouldn't be any back ratio spreads, wouldn't be any calendar, diagonal, straddle. There would none of these covered stocks. None of that stuff would have exist. They're there for a reason. You just gotta have to learn single. Everybody knows verticals. You don't need to do back ratio. It's different. Calendar, calendar diagonals is pretty much the same. Same thing with straddle and strangle. So they're both the same. Covered stocks, it's easy. Butterfly is a little bit more complicated. Iron condor is different. It's more credit. Butterfly is a little more advanced. So you can play around with, like, okay, I want to make the same thing. Let's say 93, 83. So it's a 10 points. So now you can play with the third one. Say like, okay, 93, I'm gonna do a 94, 7. So now you add more tilt. So all you have to do is just adjust the first at 10. You have to adjust the third strike, the one you've been buying further out of the money. So as soon if you're gonna make this thing more to 100, it came down to here. Now you can now you're gonna pay less debit. You're gonna carry less delta. So if you want to tilt this thing more to the upside, meaning if you want to take a bullish bet, you can tilt it this way. You can do 97. Now you 17 long delta, cost went up a little bit more, you flat theta. So now you're more directional. Okay, so now you want to go up, you're going to make money. See, the time benefits you. because you have short calls. Okay. So if you say like, okay, well, I wanted to make it balanced, you can do same way. Here. So you have a balanced butterfly now. So the balanced butterfly gives you a little bit more edge on on a theta, but the delta is going to drop quite a bit, meaning you don't have enough delta. You have $10, $6, but you're gaining time as long as the price is coming close toward your center strike, toward your 93 is where you sold. And then from here, you just gotta have to pass time as much as you can, and you just gotta have to hold for this price to stay in between until it expires. So this line right there is elevating every day to the upside. Each day you collect time. Here it expires. So anywhere in between under this line, it's all profit. The most profit that you make is right in the center, but you don't know where the price is going to close. Yeah, that's what you think. That's going to be a 700. So from $200, you make almost $800. So anywhere in between. So for protection wise, in case if just the stock just rips to the upside and you don't know that, so what you do is make the third strike a little bit short. Okay. So instead of if you bring this thing down to 103, now you paying $200 bucks, $200. So you have a loss of $209 with a downside, and you have a loss of $209 to the upside. That's the most you can lose. But as long as you can be able to stop the price somewhere in between here until expiration, that's what your payout is. But you can make the third strike a little bit shorter. That gives you a little bit of a tilt now. Okay. But you're going to pay a little bit more, but you're going to bring more delta. So now you have a shorter strike. You have a $10 here, you have a $7 here difference. Gives you more tilt to it, to the upside. Same thing you can do to the downside when if you're bearish. Now you want to play the upside. Now the price goes up. You make money, but you're gaining time as well. You can sit on this thing for a day or two or three or whatever each day. It doesn't cost you any money to hold these premiums, because your short one and your long and the one that you sold out of the money, which is way out of the money, okay, the protection is the one is going to decay fast because of the passage of time. You wanted to keep this 83 sucker in the money somehow. That's the one that you wanted to keep, your first strike, whatever your contract is. So if you do 5, you can get your 52 delta. And then from here, you're just like trying to see like how much upside that you can get. That's $1,000 trade. So for $1,000 trade, you have a potential to make almost $4,000. Where are you going to find this kind of a risk reward strategy on an entire option market? There is none. I can tell you that. Option butterflies, if you are new to trading, if you have a small account and that you're trying to grow, but you're willing to take less risk, butterfly is the way to go, because it's the only strategy that you can trade both sides, either to the downside or to the upside, or you can stay neutral. It doesn't matter, but you need to work and see how the levels looks like. All you're trying to do, instead of like everybody who is fighting time every single day, but you are sitting getting paid on the time per day. So basically everybody's fighting time because they want the expected move to pop as quick as they can. You taking advantage of the ones that are not moving. You're just sitting back and you say like, okay, you just passage of time is just paying you. You know, they always say time is money. That's what it is. Time is money. In the other case, time against you. You want the stock to move as quick as it can. Faster it moves, faster you get paid. If the stock doesn't move, goes against you, well, that's when it's going to cost you money. The delta is the delta that you're carrying, but it's just the time decay is the one that adds up. This is what most people don't understand that. They don't even know that a person who's holding a contract, okay, who's up, let's say $350, the next morning comes in, his balance would jump another $23, okay, just to hold these premiums overnight. And the other person who's sitting with a negative 50, his balance is going to shrink down to 300. You see the difference? You can adjust the same delta here. 50, you can pick a 50 delta strike on a single call as well. So, I mean, option market is an excellent way for hedging. It is hedge against your long-term portfolio. There is not, I don't know. I mean, how many millionaires are out there trading options? Unless you see them on the Twitter. Most of them are fake anyways. You make your wealth by holding stocks, dividends, returns. This side is going to pay you more over time than this side. This side is risky, but everybody's chasing this side because it has faster cash return. I get that. But what are your odds? How many trades you have to play to hit a home run? And how often home run comes on everybody's ways? I don't know, 1 out of 50 trades, probably. You're going to hit a massive run. Rest are just consistent approach and hit and run kind of trade, take a counter trend move, stay in for a couple days, boom, done. I'm trying to stay as consistent as I can. I mean, you can see everything here, what I do. I mean, I take snapshot of orders just to make sure that nobody make mistake. I will just copy the whole thing. I know something new. I mean, you can make a mistake and end up picking something else and it's costing you money. Rather just copy paste it. Just wait a couple trades you will do for a couple months. You will kind of have a much better idea how to do it and just go from there. But the point is like, I want to make this much here. I want to trade options. And I mean, you can do it. I mean, I do it. That's not a problem. But consistent approach is really, really nice. Money coming in. I don't have a mindset sitting every single day like, oh, I want to hit a jackpot today. Oh my God. One guy's one guy's making 5 grand. You're thinking like, man, I wish I would have made 5 grand. You don't know that, what his problem is, what his journey, what he's on. Big numbers all looks good. If option market was that easy, if it has that much wealth, okay. I mean, the returns over the years, I mean, everybody would be doing the same thing right now, right? Trading is hard. It's not it's not about the risk, it's the emotional game that every trader has to go. That's the tough part. You know, defining risk is not complicated at all, right? I could make a simple spread. Let's say 20 days out, I can do a little 85, 90 spread. Okay, I know like a $11 expected move, $1.88, can bump it up to like say 10. analyze this thing. Okay. So I have a $1,800 risk. Okay. And I'm $9 negative theta per day. I'm paying $1.88 for 10 contracts, buying 85, selling 95. So I'm risking 1880. I have an upside potential to make 3120. Okay. So if I would make this move from here to here, I'm long 138. That's 430, 60 bucks. I think it's bad. Or you have to just wait 22 days and you're thinking like, yeah, this move is coming. It can, but what are your odds? How do you know that the move is coming? But nobody's happy to take 400, 500 bucks. Everybody wants this. Well, you can get this, bump this one to 20. You don't need to wait that long. Make that one 20 and go back to the same way. Instead of making a 500, now you make 1100. Yeah, you took bigger risk. Now from 1800, you went up to 37. But that doesn't mean that you're going to go to zero. You need 22 days to smoke this entire spread. But the point is like, you see the time? It's in your favor. At least it's not hurting you that much. Yeah, buy at 30. Buy 10 of these. Cost you 3,300. There you go. Yeah, sit on $150 a month. Sorry, $150 a day. Each day. Doesn't matter. You made money or you losing money. You're gonna pay this much money every single day. Now it depends how long you're gonna sit on it. That's the game that you're playing. Upside is insane. But look at this. Each day, next day you come in, boom, there you go. You pay the money back. Go up, next day you went up. Each day, look, you just come here and you keep holding it, right? Even if your strike is in the money now, right? Watch. Every single day. Let's say the price takes a pause. There you go. You're up 3 grand. Now you're on just price didn't even really move. Look how theta is increasing every single day. There you go. That's how the positive position goes to negative. Learn this. This is everything for you. You have to define your risk. You need to know what are you more comfortable trading. Now, if you cannot handle a loss, what can you reduce the size? I know some people, they go nuts. It is a really simple concept. Here you have 10 contracts. Always think, okay, that one day over any news, market can sell off, company can come up with a surprise. You can lose 3,450 bucks by buying 10 contracts of 90 calls paying $3.45. You have to ask yourself a simple question. Are you comfortable losing this much money against your account? If the answer is yes, you enter the trade. If the answer is no, all you have to do to see if you can drop 2 more contracts to come down to 2760. Are you okay holding 300 deltas against the 110 to see if you can afford to lose 2,700 bucks? That's all you have to just reduce the freaking size. That's it. I'm gonna keep them at 2 grand. There you go, 2 grand, 6 contracts. I know that if I lose this much on a trade, I'd sleep like a baby at nighttime. If I'm going to lose this much on a trade, I'm going to be pissed. So I don't put myself in that kind of a spot where I have to answer a question like, why did I do this at the first place? You don't put yourself in a corner. Play the long game. You know that every trade is different. Every swing is different. Every wave count is different. Every signal is different. Every RG is different. Everything is different. There is no head to head same exact stock out there. Every stock has their own personality. It's a different business. We don't know that, you know? If you mentally decide a figure in your head, you will you will trade much better and you will make much better decisions. I can tell you that. Just draw. This is I can afford to lose $700 in case if anything happened. Nobody knows that anything. What market can sell off. Every stock is gonna drop. So you panic. You say, hey, if you're gonna take a big stock drop, I mean, what are your odds for a reversal? If you're only, you know, depends how the stock looks. Here's the thing that if you have a stock, when you have a stock that makes a lower weekly bar, okay, it's very difficult to play the upside. Just remember that. When you have a lower weekly bar, most likely the stock is just toast for the entire week. Why is that? Because when you know this, that the once you turn goes red, it's gonna stay red for the whole week. It can only turn blue. Okay. How often does that happen? Here's a weekly chart of SPY. Show me those blue bars. How often do you see them? They're everywhere. And this is a daily chart. How many did you see? This is from November lows. How many did you see? I only see two. So if your weekly bar is lower, here you have the large cap has two bars in the last 1 year. 1 year. What makes you think that you're going to have a full reversal back on your option premium? Your odds are, I don't know, less than 5% for stock to make a full reversal back. These bars don't appear that often. They're very rare when these outside bar comes in play. So the same thing when you trading stocks or whatever that you like to trade. If you see a stock made a weekly low, just either you reduce the size on that trade, or depends where you open the trade, or you just have to just wait it out for the entire week and take the punishment, or just hedge something else against that stock, against that position. You know, those are very difficult to play the upside. Like here's Dow, weekly took out 426, just keep on puking nonstop. It's just gonna close red. Like it's not gonna go green anymore. As soon as you're gonna take out the low, that's it. Your week is toast. I don't. I hardly ever pick a stock that is gonna have a weekly lower low. I mean, I'll play for a 1 or 2 point move if I'm like really, really want to, but I'm just not gonna do anything. Just let look for something else. If you wanna go up, you need higher bars. If you're bearish, yeah, then it's definitely work for you because now you need red bars. You don't need green anymore. If you're neutral risk, that's inside bars. Inside bars, you will have if you watch in a stock um by Wednesday, okay, if the stock doesn't make a new high and low for the previous week, by Wednesday around like noon time, you're gonna have a pretty good feeling the stock is just gonna close with the inside bar. It takes like 3 to 3.5 days, like almost like by Wednesday around like noon time, you will have a pretty good idea that this stock ain't going anywhere this week. Let's see how many stocks closed this week. Whoa. 70 of them. So the 70 stocks this week on a weekly time frame closed with an inside bar. Yeah. So yeah, all the black ones are the inside bars. Yeah. So how many do we have? Autodesk, anything else? Allstate. See, all the black ones is going to narrow it for you. American Towers, it's a real estate. See, it didn't break the new high, it didn't break the new low. Arista, whoa, this looks confused. See, they're all inside. This is pretty close. Should have just taken it out. Fang. Yeah, just Alta. Alta tried to recover, took a lot of beating over the weeks. Still cannot make up his mind. Charles Schwab. Yeah, you gotta, when you had a massive spike like this, your next week is a lot of time goes inside. I don't know, I have a feeling that Tesla will go inside next week. Unless it breaks to 69.49. It's making some ground back up. Yeah, so these are all the stocks that are close. Here's a Mickey Mouse. Horrible company. Just inside week. If you cannot do anything. 95 to 97. All week, 5 days. Imagine sitting on premiums. But depends, I mean, where you bought them. Let's say you bought at 96 calls to 97. That's it. How much time did you pay?
Mo, I know you picked XOM because the biggest number in XLE, but even CVX looks pretty good.
CVS?
Chevron, CVX.
Oh yeah, it's the second largest weighted
Yeah,
stock.
that's
Oh, I like every if I have to play energy, XOM is always my pick. I don't pick anything. There's no point for me to pick anything else. It's a Dow 30 stock, much better liquidity, tighter spread, the biggest market cap, follows exactly the same sector. Just play the XOM. Not so if I play XOM 100 delta, if I play Chevron 100 delta, what's the difference? You know, it's not like it's the same thing. It doesn't really matter which sector, which stock do you pick in that sector. But but it's all about how much do you have, how much you're holding. That's what matters, you know? So, well, FedEx got a weekly. This stock is this is a new company. AMTM. It's not enough. October 4. It's only a 3 week old company. Something new. I don't even know what business is this. Yeah, it's only probably a new IPO. What is that? Paxton, FedEx. The stock is crazy. Yeah, look how massive hit this stock took. How much it recovered already. Even here, this was the earning dip, and it's trying to recover this one. That's the earning drawdown. Yeah, this is too far. You see, too many of them are coming each week. Nah, it's to be a little bit far, like something like this. These are the good ones. Some of them you can catch. I mean, they pay insane. You see, like something like this. I don't like these ones. They fire too close. Yeah, looks confused. You know, I try to ignore them. If you have a bit of a gap and then something triggers, those are the ones that go. When you see this one was failed, this was a choppy decline. That's a good one. You see, you have nothing here for a long time, and then this trigger. Look at the upside. Yeah, those are the good. These are the good ones, not the ones that fire too close to each other. Yeah, I don't like those ones. It's the free stuff that I don't. I mean, I mess around and stuff. Hmm. That's daily on AMD. Well, I cashed it out here because here you see right there, same thing. See, no go go. Yeah, this. I know they have earnings coming next week. Could never know. Could just rip right back up. So AMD has one. Is this? Oh, it's the same one. AMT. So what's going on? What look up this company. AMTM. Phantom Holding. Company is just new. Weekly and daily, they're both because it's new, it's just 25. That's a $5 move right there. Deck. Of Dover Corp. I don't even know what that. It looks like a diagonal. From here, you see, you got the overlap. It might get one more push to the upside. Diagonals are hard to trade. Something like this. See, you got this overlap. So you could get one more push to the upside. Dover Corp 100. Whoa, not that cheap stock. Yeah, I gotta. Oh, my wife, everything is so quiet in the house. Um, which what is this? Equity residential is gonna be a real estate play. Southwest. It looks pretty. Got a massive down. It's a gap. Didn't really fill this gap. Nah, slow boomer and like move that much. Nah, Qualcomm. This is just Qualcomm just doesn't look really good, to be honest. This is turning into a clear 5-way move. 1, 2, 3, choppy looking 4 is your 5. If you're gonna have this as a 5-way move, Qualcomm is gonna be in trouble in like a couple months. I don't know what is that. Too much consolidation because it took such a huge hit. You draw from here, why is it? Yeah, Qualcomm is a good company, man.
Time,
This is
time-wise, it has spent too much time maybe in 4.
There's too much price consolidation here for days. Look at this. This, I don't know. Unless it's trying to make some sort of a diagonal that it can make its way up, but it has to recover a lot.
But no time relationship between 2 and 4, right?
The 2 and 4, you draw from here to here, and then you draw your fibs from here to here. Now you're gonna select these two, take those ones off. So you're gonna have multiple here. Yeah, so it's pretty close. So they're right around here. Yeah, you
That's
need to.
price fibs. What about the time fibs that you show us sometimes? That is just time.
Oh, those are on the wave count. Those are different.
Oh, okay, got it. Okay.
Yeah, that's the whole different thing. RMD. Oh, new high. No. Look at this. Making a V shape. SNCI triggered a signal. How's the weekly part looks? See? Weekly has no go. Yeah, sometimes I check both. It depends if you just want to take a tiny shot at it. That's different. Let's say you take,
WST pulled back. WST pulled back. Did it give you a go signal?
let me check the swing. So let's say you take an entry here on this 47 and you just put your 1, 2 at this low. You can do this. You see your risk reward is not that attractive. You're just risking almost 2 days down of lows of 4.5% to make just not attractive. This would be nice, where you need to take out 3 days of pretty much highs. 4.5 to this. I mean, it could happen. Again, there's a lot of um, earnings are coming out. So here's Tesla. Yeah, Tesla is looking pretty damn good. All the way up. Yeah, Tesla just clear this. You see it's 271. It's almost there. It needs to make that high. As the fifth swing down. So on the weekly side, still a fourth swing, but it has a failed signal. Sorry, the failed swing, right? Had the 137. So this stock has a very good chance, but it needs to break this high. It's 300. So this, when you have a failed swing, and this is the weekly time frame, which is gonna take weeks and months to play out, anyways, it will eventually take out this high. I don't know how many weeks it's gonna take, but it will. Fail swing has a very, very high probability that it's gonna start to swing from the on the new phase, to the upside. So the example of the same this is right here in Bitcoin. You see, fail swing. You take out this previous high, and you won. So whatever the weakness is gonna come here, which we don't know yet, uh, will be down here for the second swing. And then from there, we'll look for a third swing to the upside. So Bitcoin right now is fighting this zone. Been watching from the last 5, 6 days now. You see how many times it's trying to poke this line right there? Is struggling to break. See, break here, next day, it's close. You see all these closes, too many closes now to the downside except to the one to the upside. We need a strong close to the upside, meaning a full bar um, to open and close above this line. See, you're not getting it yet. Once we'll see it, then we're gonna hit this 80,000. It's fighting the zone, but it's not really showing a clear breakout. It should. You see how many highs are connected here? It needs to just clear this thing. Then RG looking solid. And we've been tracking this thing. Sucker was sitting here that time. I remember that. If you go back right here, look how much it is improving so far ever since from this move. So RG looks good. It just needs to a little bit of a breather or something, and boom, needs to clear this one off hard. Then we're good. If it's not, if it fails, it's just gonna revisit 60 handle again. Then from there we can look for a third print, but don't know yet. Cannot make a call yet because we don't know weekly.
Maybe it's still in one more because Mr. has been
Yeah,
going up.
it could. I mean, this one can stretch. It can go. Yeah, there's no limit
And
for it.
if you look at Mr. is just going straight up. Yeah.
Which one?
MSTR, the one we follow with Hustle
Oh
K.
yeah. That one has. Let me show you that was on a first swing now. I know.
Yeah, but there's a big gap between Mr. It's almost like Bitcoin needs to catch up with Mr.
Here. You see the Bitcoin and MSTR, they both of them has the same first swing. So the upside that you're willing to play now is either do you enter now your major support for this stock is right there at 200 is where you had the largest percentage decline. So this price, when it came back down to 200, you see how many times it poked and then it fails right there. And now it's just making its way back up. So it's always, oh, the price always is gonna break out, come back, retest this zone because you're trying to take out your previous largest decline. You just now you want to make room to the upside. So how far do you go from here? You could you can just do your fibs from here to here, just from high to low, from this 9 from 10 9 to 10. This your upside from here. So you cleared 199, cleared 226. Well, 261 is the next upside potential. If this thing's going to continue, it could go higher, but again, nobody knows that. So you don't make wild guesses. And then you're sitting with the hope like, oh, I hope it pulls back. Well,
Well, all it did, those big dark blue bars where it kind of went up and down, went up and down, those three blue bars, yeah. That's where Bitcoin looks to me to be like right now, that's where Bitcoin is. It's lagging Mister by 3, 4 weeks.
yeah, it's you have to look at this way. Every time when the price makes the largest percentage drop, when price is gonna come back up and retake this high, is going to fight that zone. Okay? Because this is where it could form a double top and then you can reject. Okay? So basically the price went down, it recovered, and it came right back to where it was before. So it becomes a resistance. So broken resistance will act as a support. Broken support act as a resistance. So it just flips. So this thing right there, when you get the breakout, anything to the downside will act as a support now. So this zone right there is your support. And you can clearly see that how long the price was trying to fight this one. Should it stays up? Should it close down? It kind of gives you a couple fake outs. Yeah, breakouts are very, very tricky, you know.
Could you overlay the Bitcoin chart with this chart just to see if my
It's the same
hypothesis
thing.
is correct?
It's the same thing.
I mean, if you overlay the from the high,
I think I did on this. Where's Bitcoin? Right there. Can do.
Bitcoin has not made a high yet. That is why I think it is lagging.
Yeah. Well, this is different. I mean, here's Bitcoin up there because MSTR is made a new high.
One of them will catch up with the other, is my hypothesis.
Yeah, it trails the same way, but you see right there, this is where you see where the Bitcoin took a leg lower. MSTR didn't. It just went straight up. So when you're gonna have this, so when you're looking at stocks, but you have to look at this way that Bitcoin trades around the clock. So the stock will trades only during the session time, right? So it stays, you see, like it stays similar, but it doesn't really get the exact same weakness what the Bitcoin gets. You know, like see, like here it's almost neck to neck, and all of a sudden Bitcoin took this couple days of decline, MSTR didn't. But then at the same time here, Bitcoin is 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 struggling to kind of clear this zone, and MSTR pushing making new highs. So and if I put M oh boy, it's going on a lot. That freezes up. I was just it's going to be a same. You see, this one is sitting right there in the weakening quadrant. Oh, it's way far. It gives you crazy delta. I mean, because it moves quite a bit. See, coin has a much better relative strength or momentum compared to MSTR. Now, if you go to a weekly time frame, they're both looking good. See, I think coin weakness would be much better over time because it is still in a lagging quadrant which has to improve over time. I think coin will have a better run. It's already here. It's still good. Momentum is pretty strong. 104. You just uh here. Coin is good because they have earnings coming up as well. So you see, just starting a one as well as a fails. I know this. I know these failed swings. You see, failed starts a new one. It's the same thing I just showed you on Tesla. Tesla weekly has a failed swing. Remember that. Yeah, this um, right there. Oh no, this daily. This it's gonna take out eventually. And it has. That's why I'm taking this and I put this thing together. I was like, if this breaks, which is this 299.29 anyways, this wave count is gonna be 100% perfect. Right. I mean, the way it's gonna go. Because that will start the wave first swing on the time frame. And then I can run a wave count with the swing side by side. They just have to match. That's all. With two different strategies, like either a swing or a wave count that matches side by side, yeah, you have a very, very good chance to be right on the trade on when you pick one. This what do you like? I sit all day just to. I'm not happy about this because it's gonna change. You see right there, and this thing changed the wave count. I even have a guy send me a comment yesterday. Um, the the this thing right there, you see all this. It just the only thing I'm thinking now is so they're all lines are coming down except for this one. And I know that we have earnings. We really need to clear this one up. I mean, if any one of this swing is going to drop, this will drop as well. It's very tricky right now. This is why it's going to be double the work for me now because now I need to match these wave counts side by side. Now it's not going to do it because you have upswing here, you have a downswing here. How are you going to match that? The two opposite. So if this thing shows weakness, then it means that this is going to extend. It's already down 2%. This one is not. The only other thing I can think of is because the SPX has been outperforming the Qs, is probably the S&P right now is taking a pause and Qs can run. It's very hard for me to see that S&P is higher than Qs. SPY. It's not normal, to be honest. Yeah, it should be other way around. A mega growth always has more potential, more upside. It's just some high beta ETF, which always has a history of having much bigger return. And all of a sudden, it's underperforming the S&P. I think it's catching up. But let me check one thing. I'm going to put them, see, and then we're going to take a break. Let's see. Do this. Let's do a line chart. There we go. And then you see, it's right there. I can see it. Qs are underperforming the SPY. You see the blue line right there is an S&P. That's the Q right there in green. You see right there? It's all neck to neck, which is fine. You see like everything. It is this thing right there. You see this gap right there? This is when Qs took a leg lower, S&P just went up. I think it's catching up. Well, they gotta move. They gotta go side by. They need to move. Like stay side to next to each other. So I don't like these ones. The SPY and the Qs really don't trade against each other. They just try to stay together. It's like this. Like see like all these they don't diverge. It's not like S&P like this and it doesn't happen though. It just they trail together. But every time it has a wider spread is when you start to see like, wait a second, what's going on here? Like you need to be like this. You see? Like this. Together. Like a hold hands and just keep walking. Yeah, when you're gonna have like these kind of a gaps, like big gaps like this is where you're gonna start seeing like tech is taking a bigger hit and S&P is not moving much. Because S&P has a lot of tech in there, so yeah, it's fine. We'll figure it out. I'm working on this TTM squeeze. Have you ever heard about this? That's a squeeze that I script the whole freaking thing, right? Look, for the whole thing, just playing around with the values and stuff. I kind of heard oops, it has default ones in Thinkorswim as well. Here, I put them in there, but I'm trying to just something new for me. I'm always bored after a certain time, just to kind of see. Well, like the squeeze is basically when when the price come like when yellow, all these bars appears like this. That's where the squeeze happens. So you're talking like this yellow bars right there, right there. So doesn't really perfectly matches, but just trying to see like this is a bullshit stuff. Let me see if I could do let's see. You see like this one MSTR is up. See that's where the squeeze. Yeah, you need a stock that has a this one. So as soon as these yellow ones, that's what it triggers. Then this blue one is the one that's the uptrend. Right there. So the squeeze triggered here. So this one was this part, and then it kind of rolled over. So you can do on a 1 hour chart. Again, it's not, nothing is perfect, but you can catch. You see, it's a nice from here. Look at the size of this bar. That's where the squeeze happened, right there. So you can definitely come across something that pops really nice for the squeeze. So like this one, you see, you just have to wait for these. Yeah, 1 hour is good. It's plain. It's a good for swing trading. So if you can put this TTM squeeze in, I think it's right there. Yeah, just search him here. This. I think you can do a trend as well. I believe. I don't know. I never did this. Yeah, there you go. Now it matches the bars with this with the color coded here with the squeeze. I think not all of them. What did I just add? Trend? Oh, this is different. Yeah, you can do those. Whatever. I mean, I'm just messing around with this on my end on these squeezes. So I made this one. Same thing, but close to it, but I'm just trying to change values and stuff to kind of see I could like you just see the yellow. So the yellow just gets narrower, gets to the certain point that the squeeze happens. So like this. You see on this side, nothing really good happened. Like, see right now, this is the red ones is appearing to the bottom because of the price is coming down. See, yeah, Q's looks good. Hey, you can catch some nice squeezes. With Tesla didn't even trigger a squeeze yet because it was an instant reaction to the upside, So you see, like here, see how similar it looks? Then it gets smaller and smaller and smaller, and that's when the squeeze happens, like this. So it's coming. I don't know. I'd expect the move is already such a huge move. Not everything is gonna be damn perfect. I mean, that would be nice. Oh, yeah, goodness. Squeeze party zone. Okay, I gotta go. What do you want? Hold on. Can you show the monthly? Yeah, the ticker is XLE. Oh boy, you guys. Doesn't have 4, 5 on Q monthly wave count. Look too short compared to 2 and 3. What do you mean? Well, no, 3 is on it. There's no, you have to compare 2 with 4 and 1 with 5. Why are you running me? I don't understand. Zoom is kind of weird today. I don't know why. Yeah, the 4 has a relationship with 2. 5 with this is fine. This is fine. There's nothing wrong with it. Yeah, WST had a setback closing this gap. Yeah, it's gonna it's pulling back. Well, it has a 3 standard deviation move. I didn't even know this company pays dividend, to be honest. The first time pharma company pays dividend. It's impressive. I'm bullish on this stock. I like this one. This stock has upside to go. Just it's consolidating. Okay. Yeah, everything is gonna change. The election and stuff. This 2 weeks is gonna be wild. I don't know. I mean, everybody assumed that we just gonna. I don't know. We could buy a lotto and just let it ride to the downside. Just to see if we can get lucky. But it's just nobody knows the outcome of the election, and it could change because the results it's not gonna be final on Tuesday night anyways, you know? So yeah, the election results can drag for a couple days. They could challenge some counts and say, hey, I mean, anything can happen. And this guy is not gonna admit defeat that easily either. He's gonna fight back, blame everyone else that was cheating and this and that. Oh no, the kind of drama is gonna be everywhere. So market will make an initial. Oh, might something never. I mean, never know. Not necessary. It might when everybody is so ready for a big, huge, massive move. Is this as something? Nothing happens that day. They're just gonna pump everything, spike the volatility, implied volatility everywhere, keep the market flat, just to crush both sides. Yeah, there's too much, too many crowded trades are never just gonna work one way in everybody's direction. Okay, I gotta go. Have a nice day. I gotta go something to eat, figure out what I'm gonna do. Okay, I will talk to you later.
Thank you, Mo.
You're
Bye-bye.
welcome. Bye bye. Gotta take time off. Let's see.